right, welcome back, everyone. Hope you guys had a great, well, it's only midway through the week, so can't have a great week yet, but we'll see how this week ends. All right, so let me actually hide this because this is kind of distracting me. So that way we just have one thing. All right, the first topic, and as always, read the description below. At the very bottom, you'll see a disclosure. Everything I say in this stream is just an opinion of myself, does not reflect the opinions of Fraxinus as a whole. So let's get right into it. You'll see the timestamps that will kind of guide us through today. There's a poll if you guys mind answering that as we get into the first topic. All right. Now, living off donations, absolutely. All right. Thank you for the donation, Kiwi Sam. I don't mind the donations, especially now that I'm doing this more full-time. Well, I'm terrible at doing this full-time. You guys haven't seen any content from me since I've sort of like quasi-retired. But anyways, getting right into the topic of today's conversation, we're going to be getting into consumer is struggling. So again, please answer that poll and I'll kind of, finish that off midway through the conversation. But if you guys looked at the headlines, oh my gosh, we're getting some donations. I should have retired a long time ago. Good evening, Fabian. All right, good evening to you too, JC. All right. So if you looked at, I don't know, CNBC, CNN, whoever you really want, there's been a lot of discussion about the choiceful consumer. I even did a little tweet. And Hugo, I saw your comments. It's not directed at you. I know for the most part you're kind of just trolling, and you're having fun with it at this point. I can tell. Don't worry, I'm not. It's not oblivious to me. So this is a screenshot shared by. This is not mine because it's not my phone, but one of the subscribers shared this to me because we were talking about this. Oh my gosh, what the hell is going on here? Loving the haircut, Papi Chulo. All right, thank you. Well, should have retired a long time ago. Apparently, you get more super chats. So thank you guys so much for the super chats. All right, let me get this out going. So you guys have seen headlines like this, but by the way, you've been seeing headlines like this for years now. I remember back in 2023 actually covering the first instance of this headline appearing, and we'll get into kind of the narrative around this, and I think there is one. So again, thank you for the subscriber who sent this to me because I thought it was hilarious to kind of see year by year the same word being used again and again and again and again. And so recently this word's been brought up, this choiceful word, which I think is a horrible word to describe what you're trying to say. And I get in the spirit of what you're trying to say is people are being, more like, oh, I can't buy that. I'll buy this instead. But use something else besides the word choiceful, because then I'm like, okay, what's antithetical to choiceful? And even in the club, I started calling myself the forceful consumer to kind of make fun of this concept. So I was like, oh yeah, I'm not choiceful. I guess I'm forceful. I'm forced to buy something versus I'm choosing to buy something. So anyways, regardless, it's a narrative that's been around for years now. And so I brought this up. I tweeted this out because I wanted to give you guys some perspective on this and say like, well, are they really struggling? Have they been struggling for just years now? And so is that, something we kind of have to talk about when it comes to this rolling recession we've potentially been in since about 2022? Because recall that typically we've called recessions before 2 quarters of negative GDP, which we technically had in 2022. We've also had, and as we're going to be discussing today, this whole signal in trucking that there's a bit of a different way to interpret it depending on how you look at it. But other sort of like names have been been telling us a bit of a struggle story since about 2022. And then we've had this whole new industry blow up out of nowhere that seemingly saved a lot of the United States economy, AI and the like. So recently we've had tons of reports. You go from Abercrombie and Fitch, Gap, you go into some of the actually we just had American Eagle Outfitters, we had Urban Outfitters, we also are going to have Lululemon next week, which we'll talk about here a little bit. And also we've had TJ Maxx, we've had Ross. I'll read to you guys some of the synopsis of like the reports. I shared this with the club members and we talked about this already, but I haven't done a public video in a while or a public YouTube appearance in a while. And so there's a lot to really unpack there, but a lot of these companies have given us some insight into how the consumer's been doing, both on the high end and the low end and the middle side too. But really the noise has been, okay, well, it's only the high-end consumer that's consuming. That's not true. In fact, we're actually seeing that's not the case, really. And if you can ignore what all these companies are saying, or you can choose to not ignore it. You're kind of one or the two. In order to believe that the consumer's actually been destroyed, you have to ignore what the companies are saying and just focus only on, I guess, what a headline is saying here and there. But if you really actually dig into the companies that do have an insight into how the consumer is doing, they have a different story. And so that's why I also tweeted, you might be surprised, or posted on X, you might be surprised by the resurgence in some of these names, but you'll only be surprised if you didn't listen to a lot of these companies. So if you go from various financial institutions who have a very good view of how consumer balance sheets look like, a lot of them have already been telling you in the prior quarters that the consumer was actually really strong, or the consumer looked really healthy, showed really no signs of extreme stress, anything like that. And all the way down the line. So from Synchrony Financial to, Bank of America, and you looked at companies like Affirm, you have people out there that are saying, of course, like the conspiracy that Affirm is lying about their delinquency rates. And we'll be talking about Affirm. As you guys know, my whole thought process on Affirm has completely changed. And this is kind of a sign to you that you should always be open to changing your mind if the facts change, if you learn more things. And as an investor, you're always learning, right? And so you should not be stuck in your ways. So the me of 2022, when I was very bearish on Affirm, to be frank, I was perhaps correct, but for the wrong reasons, right? So I looked at Affirm back then as this crazy business that, it's like, why would I be buying this whole portfolio of terrible consumer packaged loans, and just not understanding the product at all. So subsequently, and again, the blessing of through the investing community and having all these professionals from different walks of life kind of come at you, and you can see these different perspectives and talk to people inside the industry, you start to learn more, and hopefully from that learning you sort of reshape your thought process a little bit there and say, okay, well, on a more constructive opinion, while at that time there were reasons I was right to be cautious or bearish or avoidful of that company, the reasons I was may not have been entirely correct, and so you kind of evolve that opinion, hopefully, right? And again, it's good to identify when, okay, I was right, but for the wrong reasons. And so is this currently the right opinion to have? But if you look at companies like that, yeah, there's nothing really alarming. And now you're seeing a lot of the earnings reactions from retailers. And again, you'd only be surprised if you just didn't listen. So again, one of the ones we're looking at next week is Lululemon. That one, because it's going to be more of a, kind of that, a little bit more expensive clothing, but we've already had some that are not the cheapest. We've also had a lot of the attainable luxury. So there's different categories. You have, of course, I'll define it in a snobbish way, true luxury. Then you have luxury, right? So true luxury is the snobby way of saying the stuff that the actually rich people buy. And then there's the luxury that is more of like, okay, people think it's luxury, or, it could be luxury, again, depending on your definition. And that upper middle class people buy. And then you have attainable luxury that's still upper middle, but has a little bit more of a overlap between, middle and lower middle. Still high quality. I'm not defining quality, by the way, in that statement. So you're going to have very high quality products, and you should, as a consumer, if you value quality, there's still, reason. I'm not trying to talk down on it, by the way. That's what I'm trying to explain here. And then you have kind of the lower bound, the Dollar Generals, stuff that are kind of selling people who need maybe a lower quantity of something because they need a lower total dollar amount to spend. So across the board, and of course, sorry, I forgot to mention the discount retailers like a TJ Maxx, et cetera. So across the board, we had a lot of different reports and commentary on consumption. And all of this reporting, by the way, is pre-holiday sales. So, because remember, we have to look at retail in a seasonal fashion and adjust for that. So this quarter right here, depending on how they're looking on their calendars, I don't want to blanket that, but this quarter that we're going through right now, these numbers are not reflected in the prior reporting, except for companies like I guess Lululemon, who's going to have that in their guidance, right? We're going to see, like, based off the November data, what's it going to be in their guidance, but some of these other companies did not have that to guide for. So what the market was impressed was the prior quarter's figures and not really so much the updated guide. But yeah, going off of just that, you know, a lot of people are like, oh my gosh, well, what's happening here? And you saw that in the market reactions, some of them going up close to 20% at times. And again, just to reiterate, not that much of a surprise if you listened to other companies. So, all right, Becky's all over. All right, so thesis, relation of new information, absolutely. Okay, so the PayPal CEO was oddly enough, and this is more of a question, a point of concern across the board, by the way. So when you're looking at companies, and we'll look at QSR in particular, if your company is struggling with certain cohorts, you might be the exception. That might be a problem for you. But what we kind of think of, how we think of PayPal's CEO's comments constructively, is that he is someone who's not trying to, and he says this as well, make any sort of like, oh, we're satisfied with kind of any particular gain in any sector. So his comments though on the consumer only had me concerned because what if their firm is becoming the exception, right? And so you're seeing strength in other consumer platforms, but then with PayPal, you know, we're seeing some sort of like divergence, and that could be a concern as an idiosyncratic risk for PayPal. But we can talk a little bit more about PayPal later. Let me just kind of get through everyone's comments to see. Consumer debt will never recover. Forget trucking, look at shipbuilding and shipping. Any concerns about PayPal CFO saying branded checkout? No signs of extreme stress, $38 trillion later. Any concerns about PayPal? When will this guy take off his shirt and starts? Oh my gosh. Oh, is that someone else? Yeah, that's someone else. Any Android users in here? Yeah, you know whose screenshot that is. Okay. So let me get the. Oh, and another one that was struggling is Target. So, but Target again, we're kind of pessimistic on Target as a whole, just because Target has had its own issues as a company. And when we spoke to someone who had, I'll say, an undisclosed amount of experience at Target, they did not have a good thing to say about pretty much everything around their distribution and logistics, saying that they're way behind Walmart. So and that's just Walmart. We're not even comparing them to Amazon, but Target's issues are Target specific. But yeah, like I said, if you're kind of looking at your different retailers, and now be worried if your retailer is giving some sort of excuse. I think Square or Block said one of the issues they had was weather. I like, no joke, they said weather was a recent headwind for the business, and I don't know what to make of that. That's kind of also strange to say it for what they are. But yeah, so consumer struggling. If I were to kind of go retailer by retailer, if I looked at TJ Maxx, Ross, etc., for their comments on the low-end consumer. So on the low-end consumer, they said low-end consumer was particularly healthy. And we're starting to see, and again, Dollar General has had many quarters of saying the low-end consumer was struggling. So I've been covering Dollar General since like 2023. They've been saying that for a long time. And granted, when you think of low-end consumer, you're like, people who are in permanent recession, right? As if they're not moving from that bracket. So people who are, constantly struggling. And if you go back all the way to 2017, you'll see a similar narrative with Dollar General. So very frequently, or in the past even, you'll see that narrative kind of continue, right? And that kind of makes sense. And then you'll have like waves of concern. So have like, oh, this year or this quarter was particularly bad. Oh, this quarter we're seeing signs of improvement. So things are becoming more and more optimistic across that cohort. And so they're always typically negative, but it's either like less negative or it's like, oh, okay, things are looking a little bit better. And then you have Dollar Tree, and people like to point out, oh yeah, but Dollar Tree has higher income people kind of, coming in and buying. And that's more so the bargain hunting thing. Cause like this is super anecdotal, but I think we were talking about this in the club. It's like a lot of their significant others, right? They'll actually like to go bargain hunt at Dollar Tree for like little trinkets, but it's not because they're like, oh, I can't spend money at this place or that place. It's kind of this, I don't know, shopping frenzy that they get over, and they're like, oh, I'm going to go hunt for something and feel like I found something interesting. So it's like, that's not what I envision when I say like, oh, high-end consumers now struggling, or middle upper income consumers now struggling and they're going to Dollar Tree. It's like, no. I think it just became more of a trend to kind of say like, oh, what's my haul at something like a Dollar Tree? And it's not even that big of a trend, to be clear. It's just something that people point to. It's like, I don't really. Yes, Kohl's popped off. Weather is an issue. Rainy day. Month is a big issue. The downturn is fast. So, but that's just it. All right. So do you still own any TSMC? Yes, I own quite a bit of options in TSMC that I haven't sold. Do you think Adobe is a good moat, or do you think the value? Yeah, we'll be talking about it in the specific conversations about it. So if you look at the timestamps, when we get to it, we'll be talking about it. So right now we're going to be talking about trucking data. So the companies I follow, I've been following them for a bit, has been, company in the LTL space, Old Dominion. And then my favorite 3PL player right now is GXO, which was a spinoff of XPO. XPO is the other large LTL player. So Old Dominion is another compound bro stock that for the longest time, and actually we'll put up the stock here. Let me get that up. So Old Dominion was for a while this like compound bro stock, had all the traits that you like, quality company, et cetera, high insider ownership, large barrier to compete. And so one of the barriers to compete is actually the real estate that they've established, the network they've established. They are a preferred carrier, which also, acts to strengthen that moat. So when you're trying to do business with, something like a Walmart, at the end of the day, you got to use the preferred carriers. Old Dominion also, because of their, reputation and the network they've built out, they're able to charge a premium, and people are willing to pay that premium to use their services. So recently, if you squint your eyes, you can see the stock price starting to react violently recently to a lot of the data that's been coming out. And I have spoken to a few members who work in the space, in the LTL space and the 3PL space, and I believe another person in the brokerage space. The conclusion was unanimous that all of them were saying we're seeing an uptick from prior years. And so not to be, we weren't, not in like specifics in the conversation on numbers, but on like the vibes, the general vibes on how things were busier than last year consistently. So we were already kind of seeing that as far as like commentary from other trucking companies, not specifically Old Dominion. I believe actually even last month or 2 months ago, there was an insider from Old Dominion that made a positive comment. But other trucking companies as well have started to signal, trough earnings were basically here. And we've been sort of watching this I'll say a truck wreck instead of train wreck, truck wreck of these companies for quite some time. And they've been in a downturn. And it's been kind of painful to own these stocks. Not so much. Old Dominion in the 5 years still not that bad, 45%. But some of these other ones have been kind of painful to own these stocks while you're watching everything else sort of rally away. And this year, as I can kind of show you again, Old Dominion is still down 14%, with being down 30.95% year on the 1 year chart. So all that to be said is, if you listen to the trucking companies, what they've been saying since about 2020, I think the end of 2021, it's just been, pessimism. We're in some sort of recession, et cetera. And a lot of the trucking rates have gone down, but now have started to recover. I've gone down for a multitude of reasons. One of them being sort of this blame on lax regulation. You might hear that a lot. And then more regulation seems to be being enforced now. Again, I'm just kind of parroting the commentary that we've been hearing from various people on the inside. And then that's been helping kind of recover those trucking rates alongside with this increase in demand suddenly. So what we're seeing once more, if you're kind of connecting the dots here and putting together the puzzle pieces, we're hearing from the companies that would be able to tell us, consumer health, balance sheet, et cetera, being really positive, and then translation into actual consumption, which again, I didn't even get into the hospitality sector. So in hospitality, you're seeing strong demand. Travel, I'll lump that in with hospitality. And then again, in luxury, or what I'll call is aspirational luxury, not, let's say, true luxury, aspirational luxury, and then attainable luxury. Across the categories, excluding true luxury, you're seeing strength, where true luxury never has a decline. True luxury just always does whatever, despite any slowdown. Think of a Hermes and put that in true luxury. And then when you're thinking about aspirational luxury, you got to think about Louis Vuitton, which has recently recovered nicely. And you actually listen to Louis Vuitton. They pointed to particular strength out of North America in the recent earnings call. And then the attainable luxury, you got to think of your Capri Holdings, Tapestry brands, etc. So, when you're talking about a Coach handbag that can cost you a couple $100 to $600 versus a Louis Vuitton handbag that can cost you, somewhere around $1,000 something to $6,000, and then the quote unquote true luxury that's like the next step above that in many cases, and then you can throw in like Chanel in there. But regardless, coming back to the point here. So in those categories that you would say, okay, consumer pulls back on them, we're seeing a lot of strength. And what people buy, does matter. Like, where is the focal points? I believe we talked about this in prior live streams, that if necessities come down in price, that's tends to be positive for discretionary spend. So necessities being, housing, energy, etc., food. And so if we see corrections in some of those markets, and we have been seeing a much lower increase, or you could say disinflation in housing in particular, and like we were pointing out a while ago now, that the housing inflation data, of course, lags the real housing inflation data. And if you're a landowner or a landlord and you have a rental property, you probably in particular feel this year, because your rents aren't going up as much as you might like, right? And so you've been probably anecdotally feeling that in your various investment properties. But that's reflected or being felt by the consumer at the end of the day. Andrew's tagging me about something. Hold on, let me see. Oh, he's that's bullish for energy. All right, cool. Anyways, Dollar Tree is great for cheap gift cards instead of spending $8 on Hallmark cards. Yeah. We have to spend money only on chocolate. Yeah. Becky's OP. Any concern about ADP jobs numbers? So the ADP jobs numbers, if you break down the jobs numbers, what we see there is the weakness came from SMB, but not in medium and large. Medium and large actually gained jobs. SMB is the one that slowed down. SMB is the lagging indicator. So I look to that as saying, okay, what we are seeing is, and I anecdotally understand this from conversation I have, but if you don't have the clarity, which it might be, whatever is happening on, like, you didn't anticipate the consumer demand to be as strong, right? Because you read headlines, and you're a small business owner, you're not really looking at, necessarily that forward looking, or maybe as sophisticated forward looking as another enterprise might be. Then you're sort of more of a reactionary force. You're not preemptively acting all the time, as well as maybe some of these industries might, or larger enterprises might. So that's, to me, the positive side to look at it, right? SMB being the weak point is more of a I guess like okay, that's fine. Then medium and large. So medium and large gaining ground, SMB kind of suffering here is fine, because what we will see later, if that's what I'm describing, then you're going to see like a reaction to the current environment, right? And so they're like, oh my gosh, okay, actually we need to make these investments, we need to do this and that. And so that's kind of why I think the market didn't really take too much effect to exactly like that. But the ADP number, that's kind of like the gist I'd give, is like if you break down the numbers, it was SMB that caused the weak numbers, and then large and medium actually gained quite a bit. So as long as that's the case, I think it's fine. Don't like the iPhone. Look too small. Oh, that's a comment on iPhone. Which, speaking of, iPhone sales have been pretty good. That's another thing that would, in theory, be a sign of a weak consumer. People aren't buying $1,000 phone or $700, $800 phone. They would be extending that even further. You wouldn't have this like larger upgrade cycle. You tend to have a larger upgrade cycle in the time or in the moment where the consumer does feel like, oh, there is a phenomenon. I always forget the name of it, but it describes a lot of what we observe when you ask someone how the consumer is doing. A lot of people will do this, where they'll say, oh, I'm doing fine, but people out there are struggling, and then I'm over here eating caviar, right? But I know that other people are struggling. So you see, like that's what a lot of times happens when you do these consumer sentiment surveys. And that's why sometimes, a lot of times, they're not very reliable on like predicting the bottom. Usually when you have consumer sentiment at the bottom is actually really bullish, because you're like, okay, because the consumer as a whole is not very negative before things crack. They're usually very negative when things are just about to look more positive. So it's not a really good indicator, because I wish it was that easy. You're just like, oh, consumer is negative, I'll short everything, and then make money. But if I did that, I would have gotten clapped on all the consumer discretionary names recently. I would have gotten absolutely destroyed, and would not be having a fun time. Now, that doesn't mean that there aren't bubbles, because someone might hear that and say like, oh, you're saying there's not any bubbles out there. There's absolutely bubbles. Like quantum computing is still a bubble. You have even in like the neo clouds, there's the bubble there, probably. I don't know 100%. But those are two different comments. Exactly. Consumer pull is a waste of time. Absolutely. I agree. People pay too much attention to it. I care more about I really do put more weight to what the companies themselves are saying. And then you kind of, it's really hard to do. It's like easier said than done, but compiling all that together, and you as an individual investor or an analyst have to sort of piece together the story, and hopefully you're right. And if you're right, you'll make money. If you're wrong, you'll lose money. But if you're right, and you're piecing all together the primary source material of these various industries that are putting down various capital investments to expand their businesses, you'll start to kind of see through that. And be very careful, obviously, of like company says X and then does Y. Really just follow the money of what they're doing as a better indicator. But in this case, a lot of both were aligned as far as what companies have been doing. That's a great way to kind of put it together. Yeah, but anyways, like that phenomena, I forget the word for it. Some of you might remember it, but that's very true. So if you ask someone like, hey, how are you doing in this economy? They'll say, I'm doing great. I'm traveling. I'm buying this, I'm buying that, I'm doing this, I'm doing that. And then you ask the question, the follow-up, how do you think other people are doing? And they go, oh, I think it's tough out there. I went to this place and it was empty, blah, 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 et cetera, et cetera. In fact, I had this exact example, funny enough, yesterday. I won't say who, because they I think might watch these videos. But it's a person I go to frequently for let's say, commercial interaction. I'll be vague as possible, but if you know who you are, you know who you are. But you remember this comment you made to me. So The person was, telling me like, oh yeah, I went to this. I feel like people are struggling out there. And then they made the comment to me of like, yeah, I'm going out to eat a lot. It's just a funny story, real quick. That this literally just happened to me yesterday, but it describes that phenomena where they felt that everyone else around them was not doing, but they didn't have any like data to back it up. It's just like a vibe, like, oh, everyone's doing bad, blah blah blah, and then you ask them what they're doing, and then they're like, oh yeah, I'm going here, I'm going there, I'm going there, I'm going there, I'm eating out, I'm going on all these vacations, and I'm like, wow, you must be doing really well. But obviously with this person, I'm not talking about economics with them. I just put that in the back of my mind, like, oh, okay, cool, that's cool. Yeah, no, that's kind of I forget the phenomenon what that's called, but that's why consumer sentiment surveys are sometimes bullshit, and you got to be very careful if you're going to invest behind that. I would prefer going to the companies and saying, okay, what does Synchrony Financial have to say about consumer borrowing and delinquencies? What does Bank of America have to say about consumer balance sheets? What does JP Morgan, on and on and on. Like, what do they have to say about consumer balance sheets? What does, if you want a subprime book, you can go look at Credit Acceptance Corp. And you want to be careful not to muddy your perspective on just subprime, because like, yeah, Carvana probably has some degen loans. We know Tricolor was problematic. That was why we did a live stream on private credit and the exaggeration. People went above and beyond. They took the private credit narrative and they ran with it way too far. And that's why I think they look silly, because they're trying to be the next, Big Short, right? They're trying to come up with it when it's like, it's way more nuanced, and there could be simultaneously two statements true, that there are bad actors and good actors within a particular segment, and the debate should be had as like, how much of that is the bad actors. And it's like, when we actually look at, again, not to repeat from the other live stream, but Tricolor and some of these, private credit wasn't even the full culprit of it. It was like, there was, well, not even I think actually, if I remember, none of the private credit titans were involved. There were some banks involved, in fact. So, but you had some BDCs that, technically private credit. Okay, so just do the opposite of what Schwab and JP Morgan say. Lie through their teeth. Well, JP Morgan, Jamie Dimon's always the pessimist. He's always really pessimistic. And so with JP Morgan, it's kind of like they say something and do something else in terms of how they interact. But that's only if you listen to Jamie, because Jamie has a little bit of a negative bone in his body. He's always like a little negative. The day he becomes really optimistic, I'll just start being like, whoa, what's going on? Something's wrong right now. But because he's been pretty pessimistic. Schwab, granted, I haven't listened to Schwab. I usually don't listen to Schwab all too much. But the other money center banks I do pay attention to, in particular Bank of America, Wells Fargo, Citi here and there, American Express. I can confirm I feel one of my peers going on vacay and eating out frequently. Well, that's different. You probably actually are doing a lot better than your peers, Martin. You're a little on the extreme case, okay? So, like, I don't know. In your case, that there might be an actual difference between your peers. Yes, we talked about the Howard Marks cockroaches and canaries, but a lot of what he also said, which doesn't seem like he's which, by the way, himself, private credit, and Oaktree and Apollo were the ones that showed or saw the cockroach and shorted it, right? So kind of funny that the two names, because Oaktree, part of Brookfield, and Apollo, kind of names we associate with like private equity, and then private equity equals degens. This is not true, but people associate private equity degens. Ironic, is it not, that they were the ones who profited from said cockroaches that supposedly is attributable to them being in private equity space. So yeah, that's That's the gist of like what we're seeing with trucking seems really positive. That's why Old Dominion and some of these names are appreciating. I still think that they're a relatively strong opportunity, which we'll talk about as soon as we get to this next topic, which we're kind of already in, and that's the opportunity set in this market. So I'll talk about the stock I put. I put it in the thumbnail, by the way. If you guys are new to the channel, I do this ironically because I get a little bit, like, oh, that's so, but I hate that it works on YouTube. It does work. And so, you know what, maybe I should give into the dark side. But especially if your account size is, really large, I see with like, when your account size is like over the a million plus, and then you're posting like, oh, I put $10,000 in this stock. They do it because it works in the algorithm, and you say like, oh yeah, $10,000, a lot of money. But when everything is relative. And so we have, if there's a member of the club who has a small account, and then let's say make up a number, $10,000, and they put $2,000 into a stock, what I'll think of, and that, if that's like their life savings, I'll say like, okay, that's a huge conviction for you. That's like, you must be really confident. And I would want to listen, at least like, what's your pitch? What's your opinion on that? And then some people don't think of it that way. They think, oh, 2000, I'll dismiss it, whatever. I think that's wrong, because you never know who's going to have the good idea, by the way. For anyone listening out there, you should never judge on account size. And then vice versa, if, in the case of like, you have a $2 million plus account size, and then someone goes like, oh, I put $10,000 into a stock, you probably shouldn't really take that position too seriously, because it's a very small part of the portfolio. It's 0.5%. But even though 10,000 is like, oh, very, very impressive number for, at least a YouTube thumbnail, and for a lot of people. So I understand why it does well. But not to bear the lead, the $20,000 investment. Oh, okay. $20,000 investment is in Adobe stock. So what stock is the most hated right now? Definitely not Adobe, but it's among the most hated. So Adobe stock is one of the battleground stocks that I keep getting asked about. And I was asked about a lot of the battleground stocks. One of them was Fiserv, Adobe, PayPal. And the ones that I think are the more fun, that I'm psychologically and or bullish on, was Adobe, because I'm not psychologically long anymore. I'm actually literally long. And to be clear, in the what I just stated, for Adobe, that's a very small position for me. So I will talk about in the future if I end up making a larger position. But I also have a bet with Hugo, who's in the chat. Hugo, we have a bet. And so that bet is that Adobe will outperform Salesforce over a 1-year time frame. So I also wanted to put some money behind that, besides saying that. So, but anyways, so just to be clear to everyone, I'm not trying to like do a sleight of hand or anything. That Adobe, $20,000, it's a relatively small position, so you can kind of more or less, kind of think of it as like, okay, fun position. It could get larger though. But the reasons why I am have been psychologically bullish Adobe is, I think the narrative built around Adobe is a bit exaggerated as far as like what's going to happen with AI and how AI is going to impact the product itself. So for some context, I am the amateur user. I'm not a pro user. So I find no use for Adobe in my own life. I actually will use Canva, things that are more just like simple for me to use, etc. And I know what I get is something that's basic and simple. It's not going to be as fine-tuned. I can't do the fancy things that someone out there could do if they work in the space. I understand that, because I do see the difference in work quality. And Adobe's not going to get replaced anytime soon by the likes of that. Adobe also, has this like threat from Affinity Photo that was bought by Canva and is now made free. Well, after speaking to people within the industry, it's clear to me that Affinity Photo is cool, but it's cool for what it is. It's a free alternative. It's a cost-effective alternative. So for the amateur plus market, so there's like a tier in between the amateur and the pro. This amateur plus, that's like basically pro or maybe pro in their spare time, kind of side quests editors, I think Affinity Photo does everything you really need, and is an interesting product. And it's not free because it's free to use the basic stuff, and then they upsell you in the application on the stuff that you might actually want to use if you're, again, more of a pro plus. But for someone like myself, who is more just the amateur user, the free one would be satisfactory for the things I'm trying to do. And then with Premiere Pro, that one also, again, there's like Final Cut that's always existed, but the industry standard is Premiere Pro. And when you kind of look at it this way, is like industry software, there's always these awesome, because it depends on who you ask, right? Awesome alternatives to any software. And that doesn't mean that it wins or it gets adopted by the industry and replaces the existing dominant software. It's way easier said than done. So I'll give you an example. The best one to use is actually Microsoft Office. So I use both products. I don't really have an issue with using either the Google Suite or the Office Suite. I find them both to be, I'm used to both, like Excel and Sheets. You give them to me, I can use both pretty adeptly. And I know a lot of people, it's not the case where they are purists in one or the other. Actually, I know more Excel purists than I know Sheets purists. I think I tend to see Sheet purists to be more of, trying to do some sort of like project by connecting these like wacky APIs, which I also like to do. But that's more so who I see with the Sheets purists. The Excel purists are like, you throw a rock and you'll hit one. That's what it feels like. And there's this difficulty in adopting specialty software, where you have all these people that are trained on it, and once you become the industry standard, that acts as a moat in and of itself. So if I were to, I have a bunch of employees working under me, and they're all used to Adobe Premiere. Well, first of all, as a business, the license to pay for Adobe, if it's like a mission critical software for us, it's not something I'm going to think about cutting. I wouldn't think about first cutting Adobe for any mission critical software. That's one of the last things I'll really think about cutting. If for example, we're paying for more seats than we're using, yeah, that's the case, and that might be a risk. By the way, that might be a very legitimate risk. Is like the seat question. So if you're like a manager at a business, let's say, or an executive at a business, and you're looking at your making some efficiency cuts, yeah, the seat question could be one for sure. But you're not going to be like, oh, I'm going to completely switch whatever software we're using in our workflow and switch it to this new software. That's very risky, and you might have efficiency losses in that workflow when you make that change. So something that you might think you're saving by making that cut, you might be increasing in terms of cost of time, because that's a cost. So if you have a project date that you need to finish by, and suddenly you extend that time frame by some percentage amount, you can calculate what that cost is to your business, and a lot of times it might not be worth it from what will look like pennies that you're saving. So like if you had to, it's kind of like an example of buying a let's say a machine that is cheaper but works less, but then you need more people to operate the machine than what you saved on in the machine. You lost in labor costs to regain that efficiency. So that's the calculus you really have to do as a business. So I wouldn't jump to the conclusion that I found a better product. That's debated, right? That's debatable. And that's just going to kill this existing software. No, in reality, again, this is after also talked to a lot of folks who work in the marketing and editorial space. Adobe's positioning is so dominant because that's basically like the lingua franca. So if you recall our comments on FICO, why FICO's mode is so entrenched is it's the lingua franca of finance. So if I take a portfolio of consumer loans and I tell you the aggregate FICO score, and you're a person who's looking to purchase the pool of loans, you're going to know immediately what you're getting into. You're going to be like, okay, aggregate FICO score of 700. You more or less know what that means. Changing that system up, there's a lot of friction involved because I might not be able to get the same price for this portfolio of loans because I'm not using the lingua franca. I'm not communicating to the buyer in a language we both speak. Well, it's similar with Adobe, similar with Office. This friction that exists of using something outside of the norm is costly. And so for at least the industry side, yeah. And the whole question when I did videos on Adobe in the past where I was negative, this is actually really similar to how I feel, PayPal, I was bearish. I was not positive PayPal. And then I was like, okay, things are actually changing. Things are actually improving. This actually looks from and I wasn't short PayPal to be clear, but from a psychological short to switching to, okay, this is actually a good price. Let's go long. Adobe, similar story here, where with Adobe, there was a question about the growth potential in the amateur market. Anecdotally, that's me, right? Complete amateur editor. I don't need Adobe. I have perfectly, available products that are either free or easily accessible that I've adopted. I am more price sensitive for my amateur side hustle on YouTube, right? So I care a lot about price. I can tell you from, working at my previous job, an enterprise is going to be less price sensitive than me on my side hustle. We're going to be paying a lot more attention to a lot of the other benefits we get out of a software product than just like, oh, I don't want to pay $60 a month. Because that's me with an Adobe suite of products. It's like, do I need to pay $60 a month for this when I could pay $20 a month or less or something comparable and get just as much benefit out of it? That's different calculus. Okay. Let me see, is there comments? Economies, base companies like gold, silver. So I'll say, we are long in oil play. So we are long in oil play, mainly in the offshore space. Not mainly. That's a weird way to describe that. It is in the offshore drilling space. So in that way, not no metals exposure. No metals exposure, because at least for our LPs, the way we describe it is like, okay, we're looking to be a part of your overall portfolio. So if you want metals exposure, you could do that, yourself. And so we did that when we kind of structured the whole pitch of the fund in general. But no, we don't own any metals or uranium or coal or lithium. But offshore, we do have exposure. I'll say the name because I think that's fair. Andrew would be okay with saying the name too. But Valaris, we're long Valaris. So full disclosure, we are long Valaris. So that's the one we're long. Okay, so some of the other names I want to get through because there's actually quite a bit, but Adobe I think is an interesting opportunity. I have, for full disclosure, a long position in Adobe. I would like to, see what happens with earnings next week, but I've been psychologically bullish Adobe. Not everyone is like bearish enough. There's still room for capitulation for sure, because when I look online, I see a lot of positive discussion and discourse around it, but that doesn't necessarily mean, this isn't a good opportunity or anything like that. Could just be noise, but definitely it does indicate to me at least like a feeling that we could have further capitulation in the stock. So like you're seeing with PayPal, with a lot of the bulls cutting their position, that's sort of like the capitulation I'm talking about. You see some high profile bulls. Photoshop is finished because of Figma, but even Premiere is facing competition from DaVinci and CapCut now. Maybe. I don't know if I see that necessarily in like in the pro space. We will totally see that in like seat declines though. So, you could be right? You could absolutely be right. We'll see in like the next year or so if we see that seat count reduction become a lot more severe, because right now we're still seeing seat count growth. So we'll eventually see that in the numbers, and yeah, that could be something that drives the stock price lower for sure. Can I ask you a question, please, that I confused on a company thinking about? Yeah, you can ask a question. I'll answer it more towards the end because I got to get through all these companies. So some of the other companies that I think, oh yeah, Adobe still being taught in college is a big deal. All right, some of the other companies that I think are interesting opportunities as of late. Unfortunately, this one's kind of rallying a little bit, but it's coming down. Actually, hold on. Microsoft's now down to 477. All right, so this one, as it comes down, becomes more and more and more interesting. Because it's now becoming this AI loser. And the thing with Microsoft is like at the right price, I don't think this is an AI loser. I think this is actually like the easiest business to kind of integrate artificial intelligence into corporate workflows all around the world. In fact, if you actually know people in large enterprises, the stickiness, or not even the stickiness, the restrictions on utilizing various AI tools, it's like limited to Microsoft products. It's not in every enterprise, because we know people who work at other companies that use Google and they're using like Gemini, for example, but in many banks, public accounting firms, etc. In fact, in one of my comments, I got a comment recently that's saying, hey, like at all the public accounting firms, I won't say the name of that person's public accounting firm, but they said we're not allowed to use any of the other ones. We're only allowed to use Copilot. And I was like, oh yeah, Copilot, that's going to get memed. Everyone's going to be like, oh, it's the shittiest one. It's like, that doesn't necessarily matter as much. What matters is good enough and distribution. And people confuse that with LLMs, because I'm of a believer that they're kind of going to be commoditized. Like, you won't be able to tell that much of a difference. If we did like the Coca-Cola versus Pepsi test on me, by doing basic queries, I probably couldn't tell you the difference right now between them. It'd be pretty hard for me. I could kind of tell you if I'm using Perplexity or like Gemini, because Perplexity does like a tweaking on the UI, on like how it spits it out and how it looks. But yeah, on Perplexity, trying out different LLMs, because on Perplexity you can use multiple. You don't have to use only one. You can use all of them. I couldn't really tell you the difference. So now that if the formatting is gone from the equation, it becomes difficult for me to tell them apart. So then it comes down to like who has the best distribution and who has the best consumer habit. So one thing I'll say on like OpenAI, everyone's dismissing this right now, but I think that's a mistake. OpenAI right now has the largest concentration of the most valuable consumers, to be clear, as well. So not only in terms of quantity of consumers, the most valuable consumers are on OpenAI. And that's a problem for everyone else who's trying to, on the consumer side, not the enterprise side. Because the enterprise side, I think Microsoft has this in the bag. If they just have to not F it up. But if they F it up, that's okay. That's on them. But if they don't F it up, right, it's theirs to win. But on the consumer side, OpenAI has drawn the attention. Like we were fascinated because if you just use X and you just even in our own community, it feels like everyone's using Gemini. And I know anecdotally that's not the case. Anecdotally, I actually don't know anyone who uses Gemini. I was the only user of Gemini, and I now use Perplexity exclusively. But I was the only user of Gemini I knew outside of the investor community, who I knew a lot of people use Gemini. But what we found in our polling was like only the loudest people, the people who talked a lot or the most about what they use, were Gemini users, because the largest number of users, with over 50%, I think it was close to 60% who answered the poll, were OpenAI users, which I was like, okay, that tracks with lived experience, what the data suggests, etc. And the other thing, and actually what equaled Gemini was Perplexity user, which I was stunned. But Perplexity probably in at least our investment community had an equal amount to Gemini, only because I've promoted it as being the superior consumer interaction tool for LLMs. Because it's not, people confuse it. Perplexity is not its own LLM. It is a way to interact with all of the LLMs in one place. Because Sonar is just Llama with their own rebrand as Sonar, but Sonar is Llama based. So Perplexity is not, it's not, keyword not, because I get this all the time, this confusion. They think like, oh, Perplexity is another LLM. No, it's not. It's just a way you interact with it. So yeah, that being said, and again, like you should definitely try it. You're watching this. I'm using Comet here, and I actually love the ability to kind of go through the internet this way than before, and I haven't gone back yet. I have no desire. So all that being said, the OpenAI issue is that you have a very strong dominance now, and there was a new data source that came out and suggested, but I rebutted this in the investment community about the user times, because more data previously suggested that users who use OpenAI's products were using it for more time, more frequency. One thing I should highlight is that in any industry where your competitor is doing like a different frequency measure for users, and you're using a longer frequency time frame for users, that should be something you question. It's not always like a problem, but it should be something you question. I brought this up that Alphabet has been using monthly active users to measure Gemini's usage, and OpenAI is providing weekly. The problem with that is I know that you're only using monthly because the weekly looks a lot weaker. And the other thing that counts for Gemini, and I know that this is like blasphemy because I'm this is going on X, this is on YouTube, so a lot of people listening are very bullish Alphabet. And if you look at X, it's like a kumbaya circle jerking of Gemini. But you only show the monthly if your weekly looks poor. And I would probably bet you that if they did release the weekly active users, it would look really bad versus what it looks like in the monthly. Furthermore, the instance opportunity for a use measure for Gemini is very high given Google's vast integration. So like there's many different ways someone could become a Gemini user. And one example is like when you go on your Gmail, which a lot of people have Gmail, you get prompted do you want me to check over this, right? You check over email, spell check it, etc. That's a Gemini use. You use Google Sheets, Google Docs, you can use Gemini right there. And so that's all promptable, right? What I notice is that with OpenAI, there's no such instance. So a lot of it is purpose driven. So I'm going to the product to use it for this specific purpose that I wanted to. It's not because it's shoved in my face. Going to it because I want to use it. It's kind of like the phenomena where Microsoft could have, but they were stopped obviously for monopolistic reasons. But they had the opportunity to shut off, search and keep it for themselves. And the browser issue, right? Who here uses Internet Explorer? People use it, but very few. But it comes standard when you get a Windows laptop. What's the first thing people used to do back in the day? And I say back in the day, I'm being facetious with that. They still do it. They download Chrome, right? They download Chrome. They go out of their way to download the browser that they like. And so OpenAI has developed a product that seemingly is similar. They go out of the way to download or to go to interact with the product, being ChatGPT. And so that's just talking about consumer facing LLM products. Consumer facing LLM products, I think, to celebrate now is way too early. And I recall that Gemini got to like the number one for a little bit, but ChatGPT came back to number one. And if there's like a re-accel in growth in ChatGPT downloads, I would see that also as problematic, because we talked about this a lot about consumer behavior being such a strong moat. Like I just described to you with I give you a Windows computer, it comes standard Internet Explorer, you'll go out of your way to download Chrome. because you don't want to use it and your habit is already programmed. Don't think that the same thing is different this time around. Anecdotally, like I've tried to get people to use even Perplexity, right? Forget Gemini, Perplexity. It's like I converted like no one. I've only converted people in maybe CM, but that's because maybe CM where people were more receptive to trying something new. But no, people become really attached to their LLMs because of the memory that they have, and so it gets really used to your conversations, etc. So that's a stickiness. I don't know how they will monetize it. I don't work in the industry. I don't work at OpenAI. That's not my specialty. But I can say it seems like, I don't think, I think it would be like crazy to say there's no way they can monetize, 800 million plus weekly active users. So you converted from Perplexity to ChatGPT? Yeah. So Dan's a Firefox user. So, but yeah, that conversion, and it's not like, because people confuse that and say like, oh, Google's dead because of, no, that's not at all what I'm saying, like at all. So try to hear what I'm saying. It's that the battle is not over, is what I'm really getting at. And so really this year and the next year, when you start to see monetization ramp up from OpenAI, that's when the battle begins. It's like, okay, who will capture that consumer attention? And by the way, please remember, not all consumers are created equal in the sense of ARPU, right? So when you look at Pinterest, so Pinterest is still growing users, but the user who they're getting as users matters a lot. It's getting weaker because a North American user has a 10 times greater ARPU than someone in other countries, particularly in the third world. It's over 10 times. I think it's actually 50x more than some countries. So if I decline in North America and I grow in a country that's like, for example, 50x lower ARPU, I need 50 times more growth to make up for that person I lost. So I need 50 more people to use the platform for that one North American user I just lost. And when I say North America, I particularly mean United States. So I'm sorry, Canada. But it's not that Canada's that much lower, but it is lower. The United States ARPU is the highest. And you see this in every business, right? You see that in like Google's ARPU for North America is like United States is like $500 per year for Google search, something like that. So, exhibit A is like if they lose one American search user and they gain, and I think the difference is literally like 50x or something like that. But let's just say it's like 10x, and they lose one and they gain 10 in another country, whatever country it is. I'll just use that number 10 to 1. They need 10 of those to make up for that one they lost. So all that to be said is like where that growth is happening does matter a lot, and people are not also incorporating that into their calculations. So if I have 800 million monthly active users, weekly active users, and let's say 30 to 40% are North American, or 20% or whatever are North American, I've captured and dominated the North American market. And then your competitor grows in India. India has a lot more people, yes, but the ARPUs are way lower, and so you're not going to be able to monetize nearly as much. So that's a perspective I don't hear people talking about. It's like, it's not just amount of users, it's who is using it that matters a lot for monetization. So yeah, that's one thing. But the other thing I should point out, and many of you who are in school and going to marketing class, you'll learn this very soon, but consumer habit moat, which is very real and very underappreciated, and that's what served Google for so long. And that's what served Apple for so long. This habit of, oh, I'm used to the ecosystem, I don't want to change. This is the point of conversion. In order to convert, and if you're trying to think of a business idea and you're trying to dominate that, your new product has to be leaps and bounds better, to the point where using that other product is detrimental to whatever we're measuring, either like in Apple's case, your social. No, I'm kidding. But it has to be a negative, right? If you don't choose the product, because they're used to it. So what I'm getting at is like, if your product is just a smidge better and it's not noticeable, and we're doing the Coke and Pepsi test I described earlier, I have lower faith in the ability for you to take away attention. I would say it's possible, but I wouldn't ascribe like a high probability. And in the case of like Perplexity, where I would say to you guys, Perplexity is going to very likely lose, right? Because they're not going to be able to capture enough market share. Even though I'm telling you right here that as a consumer, I'm like, I think Perplexity has the best experience right now as a consumer. But here's the problem. So I probably fit more in the category of early adopter. So what that means is I'm a consumer that's more willing to try new things. And so in marketing, you realize there's different cohorts of consumers. The early adopter is someone who is going to be easier for you to convert always. They're much less loyal. They're more likely to, the Meta glasses came out, I go and buy them. The new Pixel looks really cool. I'm an Apple user. I'm going to go try the Pixel phone because it's really cool and I want to try that new feature. That's that early adopter. So that person is very disloyal, but very easy for you to capture if your product is even like, a little noticeably better. The majority of consumers are really difficult to take away from a product if your product is not very noticeably better. And so that's the problem with Perplexity. It's like it's better, I think, but it's not like if someone were to use an alternative that it's going to be like, wow, what are you doing? You're handicapping yourself. You're shooting yourself in the foot using that other product. That is not the difference in quality. Therefore, there's not going to be that mass conversion. And that was, for example, in the case of like search, there were for sure better search engines than Google, because Google would handicap themselves with like advertisements. Granted, you hear this a lot, and I heard this for the longest time. And as a Google user, I didn't care. I was in that era. I was an example of like, I'm not an early adopter. I know that. And actually, I'm not an early adopter in everything, but give an example of in the case of search. So you would probably hear this a lot too, right? That, Google has a lot of ads, and so the search quality has gone down over time, blah, 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 blah. I'm saying blah, 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 not to dismiss it. It's true, but doesn't matter. And so the other person who's telling you that, they say, hey, you should use this browser because it's better. You get better search results, more relevant to your question because it's not trying to serve you ads, blah, 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 blah. Okay, that's true. But then I reply, or in this case, it doesn't matter. Why doesn't it matter? So the consumer habit is stuck on Google search. And Google search is part of the workflow. You'll convert some people, sure, but not a relevant amount of people. And that was Google's strongest moat forever. It's still their moat, by the way. Like no one's using DuckDuckGo, or well, DuckDuckGo is not even that better, but there were others like Brave that people point to as like, oh, that one's a better search experience, yada yada, than Google was. And it's like, who cares? It's not gonna actually make a dent, because it's not so much better that using Google is shooting yourself in the foot, and that's to tie the point back. So if you're looking for a business opportunity or exploring a business opportunity, and you're actually trying to attack something that has strong consumer behavior entrenchment, if you come to me and say like, hey, I got this idea, we're going to attack this. Another kind of a let's say bad example. Well, it's a bad example because like there's a lot more moats in effect, but if you were to try to create a new delivery app platform, like, competing against Uber, it's like, first of all, the consumer habit is like tough to imply. So you would have to create a new way of travel that's like so much better. And this is perhaps the argument, by the way, to all of you who are bullish Uber and you're not concerned too much about Waymo or AV. The consumer habit moat, that could still be true. You could have early adopters use AVs, Andrew, derail the convo. You see, they're derailing the convo in the comments. Shame on you. We're gonna get nasty comments towards you now. You could have the early adopters take the autonomous vehicle and you're like, wow, this is amazing, blah, 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 blah. But the majority of consumers, or a meaningful amount of the consumers, will not do that shift until, let's say, if autonomous vehicles don't become a drastically better experience. So I'll give you an example where that becomes a drastic better experience. Let's say an Uber ride, right, with a person costs like, twice as much versus an AV ride. And the AVs, let's say Alphabet with Waymo says like, we're not on Uber. So if you want the cheaper ride and we're very reliable, we fix the reliability issues, we're always on time, you don't have to wait very long, etc. Then that difference, right, that offering to the consumer might be actually that much better, where it's detrimental to use the other one. And then, have safety concerns, yada, yada, yada. So that's really what I mean by changing that consumer habit. If that's not the case, good luck, right? You're going to get this small segment, but you're not going to get the one that you really want, the lion's share. So same thing with search, same thing with LLMs, so Perplexity, good luck to you, because the strategy is just not working. I'm an advocate for you. I'm saying like, it's a good experience, and everyone, again, to remind you, this is not an LLM. This is a way to interact with all the LLMs. But doesn't matter if you're slightly better, you're still going to very likely just lose, because you're not going to be able to convert those people meaningfully. So yeah, that's the gist. And same thing with going back to Microsoft, why it's becoming an interesting opportunity, as it kind of hopefully has more pain, is because it's now viewed as an AI loser. And I think it's one of the obvious winners. Okay, the other opportunity I'm seeing in the markets, hopefully again, is Netflix. So Netflix, one of the loves of my lives, is coming down on the purchase of Warner Bros. Discovery, how the saga has evolved over the years. So Netflix hated in the past for just being completely misunderstood by the investor base. We saw the cash flow engine really kick up into full gear. And right now they're trying to solve one of the biggest criticisms that they've ever had, which is the lack of original content, which they have a lot of, in my opinion. But the lack of the historically strong IP, think of DC, think of, House of the Dragon, Game of Thrones, etc. These big heavy hitters. And the rights to, or ownership of sitcoms like Friends, etc. So all these things that they've previously paid for in licensing fees, they are now looking to purchase the asset entirely. And for them, it's going to be a pretty easy swallow. So I see a lot of really cool synergies. I don't think they're going to just raise prices off the bat. I think they can absorb this business in its entirety along with the debt, and it's not going to be that big of a deal for Netflix's balance sheet. And in Netflix's case, I actually wouldn't mind the switcheroo of utilizing maybe some shares, given the current price. And I think it still would be accretive to shareholders. But if they want to utilize debt, I think that they can handle the debt. Their profit and their revenue and profit is fairly predictable. And on a go-forward basis, I don't expect them to increase prices too much in the near term, because it's going to be one of the big arguments they're going to make for the consumer. They're going to say the consumer doesn't have to we're not going to raise prices just because now we own more content, but that will come, obviously later down the road. So it's more going to be of a long-term story with the price increases there. Well, it's been part of the story, but you know what I mean with the HBO. They're not going to just increase the Netflix subscription by the amount that the HBO subscription cost before. And that's going to be their argument to why the consumer is going to benefit from lower costs. And the only question mark I have on this whole thing is like their agreements with, some of the distributors like Comcast, et cetera, and what that means internationally, because there is a revenue share for the HBO subscriptions in some cases. So, that I know those contracts end because Netflix is a pure play streamer. I know that some of the companies that will have conflicts with this include movie theaters that are going to say, well, Netflix doesn't, distribute that many movies, and so we are going to have less movies available, and we're going to be more concentrated in fewer and fewer players. We're only going to have Paramount. We're only going to have Disney, etc., producing these movies. I think that's not true. I think that'll be like, okay, but Netflix is coming out with movies. And remember that back in my days of pitching Netflix, I stated the one negative about Netflix is that they don't do this recapture event. So what I mean by that is like when Disney produces a movie, they put it out in theaters. And then if it recoups all the costs and breaks even, a lot of people look at that as a loss, an L. But in the streaming space, I don't view it that negatively. I say it as, like, okay, the movie could have been better. It's not a total loss. You add it to your library, and there's some value in having it and we've seen it before where movies are flops in the beginning and they become like cult classics later on. Not saying that's the norm. It's not the norm. But at least you're having this recapture event. And Netflix moving in that direction, I think, is positive because, when you do these like blockbuster movies, I love the opportunity to make a profit on the movie per se, a tangible profit, and then put it on your streaming platform. I love that concept. So that's why I don't think the movie industry is dead. I never thought movie theaters were dead per se. I think going to the movies is a social event, etc. And streaming is not going to kill them, but I think streaming adds to it. And so like you watch the movie in theaters if you want to have that social event, and then the studio has the opportunity to recoup costs and or make a profit. In many cases, make a profit. It's like Disney is very profitable in their movie segment, and then they throw that into their streaming. And I want Netflix to move more in that direction, and that could resolve the theaters complaint, which they have been moving in that direction. If you guys haven't seen Frankenstein in theaters, I think it was a missed opportunity, because I think watching that movie in theaters on the big screen, unless you have a nice home theater, was an awesome experience. And then now you have the movie forever in your Netflix library if you ever want to see it again in the future, right? For whatever reason. There you go. Stranger Things final episode will be in theaters. Like, I want them to do this. I want them to do more of this as a shareholder. I was like, yes. So I I don't even know how much money they're going to make from that final episode being in theaters. So they dare I say they could recoup a good amount of the costs for the production of the season just by doing that. That's crazy. Oh, the classic. I hated the movie. The book was better. The movie was fine as a standalone. It's fine. Okay, I wonder why Netflix. Yeah, it's the Warner Brothers acquisition, and I think it's a great. I think it's fine. I don't see it as a problem. Netflix is a tad bit on the expensive side, depending on how you look at it, but it's growing at a rate commensurate with the multiple. I do think they have one among the best pricing power out there, so I don't really see that much of an issue. Okay, so we skipped over a section because we got to get to it, but I'm just gonna change the timestamps and just say we have a lot to go over. So some of the other opportunities I see out there in the market, I already talked with them. So TSM, which, full disclosure, we are long TSM. I mean, I don't know how many times you have to hear it from companies who are saying we're not slowing down data center capex. That's not coming down. Where you have to get into your minds that, okay, there's going to be still a lot of demand for silicon. And who's selling the picks and shovels of the picks and shovels? Are you going to say, okay, the first picks and shovels layer is NVIDIA, which we're going to get to, the NVIDIA fraud. Okay, first layer is NVIDIA. They sell the GPUs to everyone. All right. And it's like, okay, I'll buy them. Fair. Perfectly fair conclusion. Okay, then the picks and shovels to the silicon engineering companies, such as NVIDIA and everyone else, or Google TPUs, is TSM. So TSM, I like to say, is the picks and shovels to the picks and shovels. Or in other words, they sell the actual wooden handle and the steel head of the shovel and the picks. And then, yeah, you have ASML, who is the selling the iron ore, you could say. And let's say they have exclusivity to the iron ore to make the steel. Or they have more like the actual and maybe the better example is like they have the machine that carves the wooden shaft and makes them. But the thing with ASML, and I'll actually thank you for bringing this up, JJ, is this is how I described it to the community. It's like they have two different cycles. So ASML and the other equipment companies, which by the way, some of them have actually had much better returns, total returns, if you invested in the other equipment companies than ASML. But ASML is the most popular on YouTube and X, but some of the other ones have actually been much better investments. Is the cycle for ASML is almost like completely different. It can overlap with something like a TSM. TSM cycles are much more elongated. And so you have to be careful when you're kind of making a direct comparison. So ASML relies on the CapEx cycle of a TSM and an Intel and a Samsung, right? So the fabs, it relies on the CapEx cycles of the fabs. And Micron, I don't want to throw up, not include Micron. But TSM relies on a wholly different CapEx cycle, one that, again, is much more elongated. And so once TSM has sufficiently invested in capacity, and now they're going to service that capacity as it comes online and they get orders, then you can start to see like there are two distinct cycles going on here. And so you got to be sort of like aware of that when you're putting your investment in. So ASML has benefited from an increased CapEx cycle from the likes of TSM, Intel, et cetera, bringing capacity online to service this really elongated cycle of silicon. With TSM, they've captured a huge portion of the valuable part of said silicon investment cycle, where a huge proportion of the more valuable orders are going to them. And the problem with ASML, I say problem, is that their customer base is very concentrated in this, cycle. Mainly heavy reliance on the big three: Samsung, TSM, Intel. TSM, on the other hand, is actually a lot more diversified than you might think. If you actually break down the customers, right, you have NVIDIA is not like half of the customers, as some might think just by, I guess, vibes and headlines. TSM is actually much more spread out. They have a lot. They have Apple, NVIDIA, AMD, on and on and on. And they've got Google recently. They took Google from Samsung this year. So fun fact, TPUs were previously made a lot by Samsung, and they switched it to TSM. So TSM continues to even take more market share. And they themselves on their own are this like monopoly that's quietly printing tons of cash. I say quietly because I think people may not have noticed how much cash is just piled up on TSM's books. They have a massive hoard of cash just sitting there. And they really, that's more of a negative than a positive, if I'm being honest, because like there's not much for them to invest all that cash. It's an exuberant amount of cash. That if some of these other companies, we might demand them to give that cash back to us, but because TSM is TSM, the management team is highly revered. We're sort of excusing it, and I'm excusing it too as a shareholder. I'm like, okay, you guys know best. I'll trust you. And I think what they basically have is like, if anything happens, they have crazy sums of money to invest in new capacity, make an acquisition, etc. They have money to throw around, and growing. They have a dividend, but the dividend, again, or the capital return relative to how much cash they're generating is ridiculous. KLAC is the nail that keeps the handle steady on the shovel. Exactly. Like there's plenty of value add businesses in the semiconductor equipment space that have all done really well. Now ASML is very clear monopoly, and I've watched from the sidelines like the narratives kind of play out. Like, China's building a competitor to ASML. It's like from the semiconductor engineers I've spoken to, it's like that's like a pipe dream almost. So it's way easier said than done to just like copy both or outcompete both TSM and ASML. ASML perhaps even more so, right, than a TSM. But TSM is very difficult. If you think one of these days, anytime now, someone's going to come and just like take TSM's lunch. It's not as simple as I buy the latest equipment, as some people might think. So TSM, I continue to see it as a relative opportunity based on forward growth, right? So trailing PE of 30, but on a forward basis, it's not that expensive at all, especially as you see them as, you know, this critical juncture of what everyone needs. But yeah. Not gonna lie, China is one. If China is the one disrupting monopoly, then it's likely BS. Yes, thank you. Yep, I completely agree, fake alias. If it's China, you know, those guys are kind of full of it. So the other business that I would like to talk about, that's kind of an opportunity, or I feel it's an opportunity, is coming for full disclosure. And I'm letting you guys know for long these GE Vernova. So GE Vernova is again at this bottleneck of the industry. So if you're thinking about energy, and this looks like a very expensive stock, by the way. So I can kind of say I believe it is deceptively expensive. Andrew, if you're in the chat, let me know if you want me to talk about what you shared with me regarding commentary. If not, I won't talk about it and I'll go around it. But if you're in chat, let me know. So GE Vernova was or is this I'll simplify it. It's similar to what actually that's probably an insult to how monopolistic ASML is, but it's kind of similar to maybe like an Applied Materials where there is competition between Lam, there's overlap, and they both compete in different segments, but I shouldn't be comparing it to semiconductor equipment, really. But they produce turbines. They produce a lot of the turbines. So in order to make energy, you need turbines. And turbine technology is actually very, very, very difficult. So it's an engineering marvel, so to speak. And there's a lot of sensitivity. So fun fact about turbines, for the turbines to make energy, you need to be there's like a sweet spot, like a perfect sweet spot of how the water vapor goes through the turbine. If you even have a little bit of water come about, you can absolutely destroy this very expensive machinery. So everything from the pressure, the temperature, everything has to be perfect. And I can't imagine as a civilization how many of these we went through before we figured that out, or maybe we didn't need to go through that many. I don't know, but it's kind of fascinating to think about the perfection you almost have to put an environment in to make these go, because like just water, you know, from how fast this is moving, can just destroy the turbine. But anyways, so producing energy doesn't really come out to anything like, you know, different. It's all turbines. And producing these turbines is, again, way easier said than done. So you have Siemens Energy, GE Vernova, and Mitsubishi as the three players. And they all have their different strengths and weaknesses. Some have a bit more strength in you know, the whole network, etc. And there's a lot. If you guys know Otis, the elevator company, that you have sales, and incremental sales leads to a push in service revenue. Well, GEV, in my view, or the way I think about it too, is it's the same thing. So the equipment sales is a leading indicator to your service revenue. In fact, actually, ASML is the same way, and a lot of these other equipment companies, their equipment sales is a leading indicator to how the service revenue will be. So for GE Vernova, I'll talk a little bit about some of the accounting here as why they might be deceptively expensive. So in the first instance, they have this wind turbine business that's been losing money. A lot of those wind turbine contracts were negotiated previously under let's call them bad management. Double on a spin off. Yes. They were a spinoff. So if you bought GE before all the spinoffs, you made a killing. But with GE Vernova, they have a backlog that keeps growing. They are booked in orders all the way through the end of this decade. And they are raking it in with the traditional turbines. But the wind turbine business, they are losing money. And when you go in and extrapolate what that looks like, I should backtrack. They had a recent announcement that caused the stock price to go up 6% in a day. It was a signing of a contract for turbines, wind turbines in Taiwan. The reason why the stock price went up so much that day was, and again, if you're not paying attention to this, probably be confusing. The context missing is their current wind turbine business, which is losing money, is based off of contracts that will all be finished renegotiating by 2027. So with this new contract, we got insights to how these new contracts are going to be renewed. And then we will also get potentially not only just like a losing business into a break even. Well, actually, they could be profitable, which is why the stock market or the market reacted the way it did. This is maybe a statement that was said. You never know these days, but the administration also praised GE Vernova. So two conflicting comments there. I am not going to fact check that, but the comment, but it sounds like I don't know. I don't know if he did or didn't say. You never know these days. But anyways, so coming back to GE Vernova. So what you have as a setup is like this losing business will likely be at least break even in your assumptions. You can say that by 2027. So that alleviates a lot of the EPS overhang. You have this other fast growing business that's really all about, improving capacity, but not too much, but improving capacity. And then of course, pricing power. And then you have the recipe to still, even though, you see it like, oh my gosh, it's a $163 billion company. No, it's probably got more room to run. And everything that's telling you about the grid, the investments we need to make globally, not just the United States, tells me there's still earnings growth left in the gas tank. And if you see any sell-off, I think that's a gift. If you don't see a sell-off and it continues to run, again, deceptively expensive in my opinion. We are biased because we are long, full disclosure, but yeah, great company, really tied into where one of the bottlenecks of energy really is, which is if you want to make more energy, you need more of their stuff. Okay, and then to the next one that I think is an interesting opportunity is ODFL, Old Dominion. So if you think trucking's coming back, LTL, great company. I already talked a little bit about them earlier in this episode, talking about what's going on with trucking. Probably the best LTL operator out there. If you want, 3PL, you got GXL, Disclosure, we're long both. Yeah, ODFL, interesting. I'll throw in another one, kind of more of a rapid fire. I can talk about Apollo and say Apollo, I think, is also an interesting opportunity, but actually we'll go straight into Apollo because Fuhat's asking. So Apollo Global Management, private equity, misunderstood in my opinion. This private credit Armageddon, greatly exaggerated. Apollo, for Pete's sake, they literally shorted the Tricolor First Brands debt. They made money from it. Obviously, there's some information asymmetry that you have to respect here. They've proven time and time again that they're great capital allocators, great managers, great underwriters. So at the end of the day, I have no doubt in Apollo specifically, but really throw in Blackstone, KKR, et cetera. They have great talent, great demand for the products. We heard, private credit or private equity is dead. There's no demand. Then they show us what they're fundraising. It's like, where's the demand slowdown? Where am I seeing it? I'm just not seeing it for what. And I get it. Like, it's looked down upon by a lot of investors because, you know, oh, you don't get a lot of transparency, et cetera. Heck, you know what? That's what institutions want at the end of the day. A pension fund or an endowment, they kind of want that, not transparency. What can I tell you? So, yeah. What else? What else? I also wanted to talk about, I have it in my list here. Oh, we're going to get into NVIDIA. We're going to get into NVIDIA and Michael Burry's comments. Is it a fraud? But not just in Michael Burry. There's other people, because there's Michael Burry saying some things and other people are going way further than Michael Burry. And I'll say that for Michael Burry's comments, it's going to be a lot more respectful towards him, because he's not, you know, he could be wrong, but he's not like going off the walls like some people are. But yeah, I think it's fair to go into that. Let's go in now. So NVIDIA, there's been this whole discussion about whether or not NVIDIA is a scam. Oh, and let me actually go ahead and change the timestamps so I don't have to remember to do this. So we are in minute 1 hour and 39. All right, so 1 hour and 39, we talk about NVIDIA. And then I'm going to remove Q&A and just assume Q&A is just done throughout now, because otherwise it's too hectic. I've heard Apollo employees are business geniuses. Their credit swap and the following private creditors was a testament to that talent. Absolutely. No. Like Apollo's talent, all the people I know that either have worked or know people that work at Apollo, great. Yeah, and I think Andrew is correct there. Burry's arguments are fair. I don't agree with him necessarily, but they are fair. Other people are just idiots, and we could talk a little bit about the idiots, but I'll try not to name them. But I'll start with the idiotic arguments first, and then we'll get into Burry's arguments. So the idiotic arguments first. So to be very clear, these are not Burry's arguments, and Burry went out of his way to say these are not my arguments, right? So these are not Burry's arguments. We're going to get to Burry's arguments. So the non-Burry arguments is that NVIDIA is committing accounting fraud. This is not true. This is far from the truth. And what they point to is hilarious. It's rising inventory levels as a sign of fraud. Those people don't know what they're talking about. Those people have no idea what they're talking about. And you should question everything else they say after that. And in fact, those people should not be named, have been in cash for a very long time and have been telling you that, you know, things are going to crash and get worse and worse and worse forever. Eventually they'll be right. Eventually. But they're not going to be right now. And onto the, you know, first of all, the inventory discussion. It's like rising inventory by itself is not, and pointing to accounts receivable and the relationship to it, is not in and of itself, right? Smoking gun, yada yada. Financing sales in any respect is, first of all, a perfectly normal thing for businesses to do. If you've ever run a business, you've probably financed some of your sales. You also probably have another relationship with your supplier that you do engage in some financing. If you are buying something and you're not trying to also engage in financing, you're also not managing your capital the right way. Wow, that is a retarded argument. Yep. They saw a video on Enron. Yep. All true things. So they're comparing it to Enron. They're comparing it to this, to that. Those are crap. Now, let's kind of put that to the side. If we have any more comments or questions about the dumb arguments, we'll get to it. But I want to spend more time on the Burry arguments. All right. So Burry is making more of a comparison that I think is more rooted in something, a semblance of logic, right? That I don't agree with, to be upfront. I think that, which by the way, fun fact, this channel was talking about the ASICs thing way longer before everyone was talking about screaming about ASICs on X. And so, by the way, I was unfortunate to be scared of NVIDIA because of ASICs, because I was wrong. You know, there you go. So because it is technically correct that the you know, the ASIC revolution came, right? But it didn't come in the way that I was interpreting it based off the you know, acknowledgement or the learning of ASIC's existence. And I thank the community for educating me on, you know, GPUs, ASICs, et cetera, and what their purposes were for. My interpretation of that was incorrect, and I concluded that, you know, NVIDIA was just going to be like a very short spec. I don't think that anymore. Do I think NVIDIA is the greatest opportunity in the world right now? I also don't think that. I'm not arguing for that as well. And I'm more comfortable investing in TSM because of that lack of deep level knowledge that I'm not, you know, a semiconductor engineer. I'm not someone who, I don't think I'm going to time some sort of like relative top with NVIDIA very well. Just because of, you know, needing that engineering backbone in you to really figure that out. I am only going to be relying and borrowing the confidence of someone else. So I've tried. I just can't get behind or get really comfortable with just like holding NVIDIA like that, especially here. But that being said, when I hear these arguments, I'm like, oh, okay, hold on there. So the argument, if I had to summarize it, well, before we get into that one, I do want to say some of Barry's points don't make any sense. In particular, the SBC tangent he's going. I did tweet at him. Obviously, he's not going to respond to me, but I tweeted to my audience who cares to hear what I have to say about it, that I think it's thesis creep, where he's going off on a tangent that doesn't make sense. And I tend to view thesis creep as a sign of weakness of your original thesis. So if it doesn't stand on your original points and you're trying to make these other points that do not make sense, I start to question more the integrity. When I say integrity, not like his personal integrity, the integrity is in like does the argument stand on its own? I start to question that, because it's like you're adding this thing and that makes no sense why you're going there. So I'm gonna have to look deeper in the rest of what you're saying, because if this doesn't make sense, maybe the other stuff doesn't make sense when we dig a little deeper. And then the comparison, you know, he draws, so kind of that's to the side comment on the SBC. The main comparison he draws is Cisco. So, oh, and we'll get to the depreciation argument. Okay, so maybe we should start with the depreciation argument, and then we'll get into the Cisco argument. Either one, there's a lot to talk about. Let's start with depreciation. So the Cisco argument we'll save off for a little bit later. The depreciation argument. So him and Jim Chanos have had the same argument for a little bit. The problem that I have with that, and he actually points this out as well, right? He does an acknowledgement, but I think it's like an acknowledgement, but also like a brush off. The silicon that's old at this point is still being used, and the depreciation in accounting, we're trying to reflect the useful life of the product. And he did do, actually, I'm trying to remember the exact quote now, but he did actually misconstrue the useful life, economic life, and all that. He tried to draw some comparison that it's not technically correct, but the premise of it is that they're lying about the depreciation. Maybe lying is a strong word, but they're misleading people on the depreciation. I don't think so, because where you would start to see that a lot is on a loss of disposition of assets. Now, you could keep going with this tinfoil theory and keep making excuses to why you're not seeing it. So, for example, you could say they're grabbing all these GPUs and then they're throwing them into a cave and just like not using them. Because if you miscalculate the depreciation schedule of an asset and then you dispose of the asset, you don't just like sweep that loss under a rug. You record a loss on the disposition because you had recorded value on the asset and then you got rid of the asset. So you write the whole thing off after that. You basically do like a later extended depreciation kind of the rest of that value. So like an example, I depreciate something over 5 years, and then after the third year, it's useless. So on that third year, I get rid of it. You don't just like keep depreciating the asset for that 5 years after you got rid of it. You write off it as an expense at that point, whatever you can. And then same thing, if you were to sell the asset, the difference would be either a loss or a gain. So if I depreciated it to zero over the 5-year period, and someone bought it from me at something over zero, I record a gain. Or similarly, if I depreciate it over 5 years, on year 3, I sell it, but I sell it for less than the book value, I'll record a loss. Okay, so loss on the disposal of the asset. Or if I just dispose it, throw it away because no one would buy it off of me because it's worthless, I would write off the remaining value completely. So you would see it by now in a lot of these businesses, which we're not, which makes me go, okay, this is probably an exaggeration. And we would have seen it also being caught by in the auditor's notes, etc. Again, you can make excuses for all this and say they're putting it all into a cave and they're not using it, and committing fraud. Basically, you basically have to assume they're committing fraud to get to a point where you're justifying why we're not seeing it. Like you kind of have to go in that direction. So that's where I'm not there. And Jim Chanos even shared a chart showing the rent costs of GPUs that were old, basically defeating his argument, because he argues that after a certain period, they're lying about the depreciation, and yet there's still a monetizable rate, right, on those GPUs that are old, right? So it means that they're still useful. They're still generating economic value, per se. So all that to be said, and there's also this nuance. I'm going to parrot what a lot of the engineering folks have taught me. So, because again, I'm not an engineer, so everything I know is I'm learning from others. But for those of you who are just like, kind of a past buyer in this, and I'm going to pretend most of you don't know what this is, but again, like my audience, we already know all these terms. But there's a difference between training and inference. So training, when you hear about all these companies, and I'll do a whole video on this because I want to do videos again, and I think these videos, breaking down these concepts into a small video, I think people like, because then it's I think helpful. But training, for in layman's terms, this is the expensive thing that you hear about, right? When you're training an LLM, this is the thing they're spending the big bucks on. When I hear Anthropic, OpenAI, Google, everyone, they're spending tons of money. It's typically on this training thing, right? Inference is, I go teehee, let me look this up, yada, yada, yada. What is the color of this hot dog? Or what is the color of this cloud in this picture? That's more of an expensive query to analyze an image, but correct my grammar in this statement, right? Something simple. So that kind of query, that's what we're talking about with inference. Inference is actually pretty cheap, very cheap. And in fact, there's a strong case that if we're just taking into account inference costs, a lot of these companies actually can be profitable tomorrow, which is crazy, because a lot of the cost is actually in the training, not the inference. Inference is actually can be quite monetizable, which makes me more excited about the future for some of these companies. Going back to Microsoft, I think Microsoft can actually do really well with inference queries or inference workloads, and that can be very profitable. Training, if you're spending on training, obviously, if you're the company that's charging for the training compute, right? It's on your cert, like you're still making money. You're charging what it costs to do the compute, etc. But that's what the separation I wanted to draw upon is, like in the expense world for AI, you have training and you have inference. So when we talk about inference, a lot of the new silicon, as it gets older, we switch it over to inference. And then the inference side, the demands for compute or the demands on that workload is a lot less. It's not as demanding, as expensive as training is. So long story short, what we're seeing is like this cycling through, and these purpose-built silicon, these ASICs, are going to be really good at the inference aspect. Like TPUs, Trainium, etc. Well, Trainium is meant to or designed to also be good for training, and TPUs also, right? They're trying to get it well enough to do everything. The inference aspect is like where we're really going to see this cost push down focus, and then training, because that's like the focus of like where the arms race is. You're always going to try to be using, well, what is the best? What is the best for this? What is the best for that? And I won't get into the specific NVIDIA just yet on like what their mode is and like why it's very hard to surmount, right? And why the CSCO argument is not comparable. We're going to get to that in that discussion. But to summarize on the whole, depreciation aspect, like one, again, you would have seen it in dispositions, very, very likely. There's ways you could, work your way mentally to say you wouldn't see it, but you have to conclude certain things, which I'm not comfortable with doing. Could be the case. Could be they're all just committing fraud, but I don't know about that. And then the second, or the most important second point, is like we clearly do see use cases, economic use cases on the back end of their lifespans. He also said COVID vaccines cause cancer. We all have cancer. Well, I actually didn't know he said that. I didn't pay attention to him too much on, but I don't know anything about that, but yeah. I can look at live person after this. Okay, so now let's get into the really fun conversation of Burry's arguments. Okay, and that has to do with, oh, they're the next Cisco. So why do people compare it to Cisco? I'm gonna again pretend like my audience, you guys, first time you're hearing this, blah blah blah. So I apologize. You're like, oh, we already know this, because I know a lot of the viewers, you guys are in the CM club, so you guys are like, we already had this conversation. But to reiterate, this is why it's being compared to Cisco, because Cisco was the epitome of .com. And in his written arguments, he says Cisco reported increasing earnings or increasing sales. That's where I'm going to caveat him first, or pin that comment first. Increasing sales during the collapse of the .com. So let's first distinguish with what happened in the .com and what happened now, or what's happening now. So the .com bubble, which many of you probably were not investing back then. I was not. We can only read about it and listen from the veterans of what it was like. But there were plenty of companies that had no profits, no revenues, right? To Burry's point, he says, well, I'm not talking about those guys. I'm talking about the true picks and shovels plays. I'm talking about Cisco. And Cisco was a picks and shovels play to those, to some of these companies. Who? It was the AT&Ts, the Verizons, etc. So the Charter Communications. These guys were laying down the groundwork of fiber for this future of internet consumption. Now, before we begin, in this case, those companies would be the hyperscalers. The hyperscalers are laying down the groundwork for future consumption. And that would be like an AT&T or a Verizon or a Charter, right? Setting down all that fiber, paying for it. And Cisco benefiting, Cisco being NVIDIA benefiting. So I hope now we have this, comparison. Cisco's NVIDIA because of X, who the hyperscalers are, etc. So what happened though back then is Verizon would build out this fiber network and say, you know what? I build it and they will come. I build it and they will show up. They will eventually come and use the demand. They were right. It just took a long time, and we still haven't utilized all of it, right? So for a very long time, it was a massive surplus to what we actually needed. But for that moment in time, there was this idea: we build it, they will come. And there were some internet companies being born from that, right? And utilizing the infrastructure of the internet. Absolutely. Some of the greatest companies on earth, Amazon Web Services later, came from that era. And And then for every Amazon, we had plenty of other random shitco that didn't make any problem. But Burry's not talking about that. He's just talking about Cisco in that context. But I say, wait, there is a big difference. The hyperscalers are building to meet demand. There's a very big difference right there. AT&T was building in anticipation of demand. Amazon is building to match demand. All right, let me one more time. AT&T, Charter, Verizon, they were building because they thought demand would show up eventually. Amazon is like, if I don't build, they're going to go to my competitor. Google is saying, if I don't build, they're going to go to my competitor. Microsoft is saying, if I don't build, they're going to go to my competitor. These guys have massive backlogs. They need to satisfy the backlog. I won't say, I'll keep your privacy, but, we've been told from folks at one of the hyperscalers, I'll even keep that private, one hyperscalers, it's like the pressure to meet the demand is very high right now, because literally, if you do not build it and your competitor builds it out, they're going to get that business because there's that much demand and you need to build. There's not an opportunity. That's why there's been this opportunity for the neo clouds, for the oracles, etc. And we'll talk about the neo clouds too, because I think that's interesting, like a Nebius, an Iren, yada yada yada, CoreWeave. So with CoreWeave, we'll talk about the neo clouds now. We're going to do a quick segue into the neo clouds because it's pertinent to why we're having this obvious demand cycle. So CoreWeave is a neo cloud. In essence, what they're doing, they were a Bitcoin miner or crypto miner of some kind, and they swapped their business model to focus on data centers. That's the story of all of them, Iren, etc. CoreWeave does not, at least until recently, own the data center itself. They own the equipment, but not the data center. So they own the compute equipment. What they're monetizing is risk. And I'll explain what I mean by that. So when I'm going to CoreWeave, I don't want to put up the upfront cost to the product. And so the economic benefit that CoreWeave is providing me is that I can transfer some of that compute capacity over to them, and I don't need to make that upfront investment, and I put the risk on them. They get a profit out of that. We don't know what profit that is at the end of the day. The net profit margins, we have no idea. I believe it's going to be mid to high single digits. Not very good, but a profit nonetheless. And the reason why they're making a profit is they're taking on risk. So kind of like market dynamics there. I, as a hyperscaler, take on less risk through them, or by that relationship that we have. So the neo clouds are getting a lot of business because there is that much demand, where Microsoft, Alphabet, in some cases Amazon, are deferring some of that to these companies. Oracle also being another one of them, where Oracle is getting a lot of the training compute that Microsoft is pushing off from OpenAI. Microsoft wants more of the inference. Hey, remember what I alluded to earlier, the inference stuff. And Oracle is going to be getting a lot more of the training compute. The differences between training and inference, as well as there's a key detail that's needed to be understood before we continue. So inference compute, it's much more important the location. What I mean by that is, if you want to not have a lot of latency or decrease the latency between your end consumer in New York City, it's much more important that the inference compute is happening close by, otherwise locally. And so that matters a lot for whatever real estate constraints, energy constraints, yada, yada, yada. If you want to service that market, it matters a lot. But for training, that doesn't matter. You can be out in the middle of nowhere and you can do all the training you want, because the latency problem is not that much of a problem. So CoreWeave has a lot of great locations for training specifically. And those locations, you tend to have cheaper energy, cheaper land, all those things that are nice. So it's very convenient. But anyways, going back to it, the internet companies, so Cisco versus the internet companies, they were building to anticipate demand, Hyperscalers building to match demand. It's very different. And the all this to be said, the already like the market dynamics there, it's going to be really a question of like, does demand fall suddenly, you know? And it's not demand for the infra, it's building out the infra. So like not demand for GPUs, it's demand for the compute from the customers asking, I want more compute, I want more, I want more, I want more, I want to use this, I want to use that. And that's what cloud has really been for the past decade or so. It's like matching the demand for compute. So that already, I mean, we're already kind of making the point. It's like why it's not Cisco. The other point of why NVIDIA is not Cisco is Cisco's fairly commoditized product. He does point out in his writings that Cisco, their revenue was going up, but he doesn't mention the profits, or I didn't see the profits. And someone can correct me if I'm wrong, but I do not recall a mention of profits. I do recall, of course, I'm pointing out revenues were going up while the dot-com bubble was bursting. But at the end of the day, what Cisco provides is much more commoditized than NVIDIA. My caveat, my asterisk on there is if it ends up becoming true that ASICs surpass NVIDIA, you could be right for the wrong reasons on only NVIDIA particular. What I mean by that is the AI investments could continue to do well. So like a TSM doesn't care. They'll make whatever ASICs you want. But an NVIDIA could suffer in this hypothetical scenario, and then you're still wrong because the investments are still being made, etc. Well, Google's being mentioned in the context of the TPUs here, but Google in isolation. Ask me what you want to know about Alphabet, and I can share my thoughts on it. But yeah, so that scenario, yeah, sure, NVIDIA could hurt. NVIDIA would be more commoditized, but that's also ignoring the other moats that NVIDIA has built, particularly in the software stack CUDA. So recall what we talked about with Adobe and some of the moats it has there. NVIDIA has a similar moat in CUDA, where it is the industry standard, and a lot of folks know how to work on CUDA. Changing that up is going to be a lot easier said than done. And NVIDIA has that massive advantage. Cisco never really had that advantage, nowhere to that degree. Another reason why they're just not very comparable. Cisco may be more comparable to like a CLS or some of these other, which are frankly more commoditized. And more of a supportive role than anything else. I want to caution and say CLS maybe not as commoditized, but maybe like a Flex, CLS, still putting it in there. Oh my gosh, forgetting on the other one, Jabil is the other one. So these like contract manufacturers are providing like this kind of a equipment, but it's nothing truly hyper specialized that you can't find anywhere else. NVIDIA is more specialized. So all this to be said, the core, and the argument he has, which I'll try to pull up this image because it's pretty important to the conversation. Let me get this chart he puts. Okay. So he uses this chart to make a point about investment cycles and the like, and I want to also express like why this is misleading. So first of all, I think the first one that should immediately stand out, and I don't have this image in front of me. I believe I tweeted it at some point, but the percentage of GDP, when you map this out as a percentage of GDP, because you're talking about like high level, macro level, it's nowhere near. Dot-com bubble was insanity. Then we zoom in a little bit. This level of total investment relative to the company size is ridiculous. Because again, who are we talking about? Well, when we're talking about the investments over here in the cloud AI boom, we're talking about the hyperscalers who are on a completely different level, completely different size than AT&T, Verizon, all these companies ever were. Just completely out of this world in terms of size comparison of these companies relative to other companies. Just, adjusting for inflation, whatever you want to look at, totally different. Balance sheets, totally different. So like Microsoft, for example, has AAA rating. Only 2 companies I know of have AAA rating. Google, tons of cash. And for the time being, like search is like printing money. Meta, the ads business, printing money. On and on and on. The only one you can maybe say on put a question mark behind it is Oracle, but the others, like, come on. And then same thing with energy over here. So this energy, this is also like, okay, but that's more to do with energy booms and busts. And the shale revolution, right? The cure to higher oil prices is high oil prices, right? That's not necessarily the case with compute. That is a bit more differentiated. It's not, remember, we're not talking about hundreds of hyperscalers. There's the big 3, and then Oracle is trying to squeeze themselves in there. It's not really, we're not apples to apples. But anyways, coming back to this, it's like when you do a relative size comparison for the companies, this was a much harder pill to swallow for the companies involved than it was for this. Like the legacy of the dot-com era was riddling or saddling these media or these broadband companies with astronomical amounts of debt that crippled their returns for years to come. They underperformed for many, many, many years. And still to this day are not very strong performers. Arguably, if they had invested the appropriate amount and their balance sheets were relatively healthy, the amount of capital return available to shareholders would have been, way above and beyond what they were in reality. Oh, okay. This is a great question. We'll get right into it. But because I'm wrapping this up. I posted earnings today and said that there is diverging consumers, those that have and those that are struggling with affordability in Canada. In Canada, I will say that is more concerning to me than the US. But remember, Canada is also starting off from a weaker footprint when it comes to unemployment. Canada is a much more export-driven economy than it is a raw consumer-based economy. So the thing with Canada, and this is something I tweeted about during the beginning of the whole tariff wars, etc., is that the United States, it's a bit oversimplified, but if you do a line-by-line comparison of like what is imported, what is exported, you have to care about elasticity. Common economics concept of elasticity of demand. If a product is inelastic, it is less sensitive to prices. So quantity demanded is less sensitive to the movement in price. If it is elastic, it is more sensitive because the curve is less steep. And with tariffs, we have to really actually apply that analysis to product by product, basically. What you find is the United States exports are typically more inelastic because the manufacturing base of the United States has been hollowed out to the point where most of the manufacturing tends to be more inelastic than elastic. And because by virtue of, okay, if it's not price sensitive, then it's probably not going to care about, moving product to a cheaper production base because it doesn't care about product price because the consumer will pay whatever for it. So it probably is going to be stickier. But like a textile mill, consumer is very sensitive to price. It's a very elastic product, lots of, substitutes. So you're going to move to the lowest cost production. So with Canada, because it's a more export-driven economy, one of the points I made back in the day, earlier this year, was that I would be more worried about Canada. And when I talked on panels regarding High Tide, which is a Canadian retailer for cannabis, I expressed concerns just on that. But the other panelists told me, those concerns are not. They didn't disagree with the concerns themselves. They said for the product category, it's not going to be that big of a deal, which it's seemingly not. But they weren't negating the broader issue, to be clear on that. Okay, so but let's get right into it, because I think I wrapped up why is NVIDIA not a fraud, why it's like, okay, having the argument about it being overvalued is very different also from calling it a fraud, is also very different from calling it CSCO. I think NVIDIA still has gas left in the tank. I have no position in NVIDIA. So full disclosure, I don't think I'm biased necessarily in saying this. So if you're an NVIDIA bull, I think you're still going to have greener days. But I'm just making a point of saying that it's not a fraud. And I don't think HyperScale is doing shenanigans with depreciation schedules. I also don't think that it's comparable to CSCO. Those are my points. Summarized, over. All right, let's get into, or come back to Canada. So, and then we'll get into Google. And so the tariffs not having an effect on Canada is maybe worse, because if you're saying that that's not the impact just yet, because like the major industries, the Canada exports, which, wait, that's right. I'm forgetting. We're talking about Canada. The added nuance, by the way, is that the tariffs weren't impacting the products in the first place that were part of the agreement, which always expired in 2025. So I'm going to add that it's just noise. The prior agreement that we had with Canada on this free trade agreement, the tariffs don't really impact those products, right? So those products are mostly the exempt products. And so realistically, Canada shouldn't be experiencing too much. The only thing that could be affecting Canada is like the in business uncertainty, so lack of investments, lack of borrowing, etc. And I believe we actually did see data from the banks going back into the summer that businesses were borrowing less, and so that does have like knock-on effects later on, which we're probably seeing now. Then, but yeah, that's an added point I forgot to mention, is that Canada's tariffs, they weren't even affected, but it being an export economy still impacts business investment sentiment, and that could have been what's causing this impact here. So it's like, while the tariffs aren't doing anything really, because they're not affecting, as long as the product is part of the agreement, which expires this year and should have been always renegotiated. It was always meant to be renegotiated in 2025, which makes more sense that it would be hilarious a timing of a new trade agreement in 2026. Because that was always meant to be the case. The only problem where it does become a problem is if that trade agreement lapses and we have no replacement. Then the uncertainty becomes reality. But now, thinking about it out loud as we're talking, it's like, okay, well, if I'm a betting man on this, it's like I probably bet that the data we saw earlier this year on Canadian businesses slowing down borrowing, and that's what we saw in the banks, then we from there surmise, like, why did they slow down borrowing? Because they don't want to spend as much. I'm trying to think as an operator. It's like, I would borrow less if I don't want to spend as much. I want to pull back on spending. Why would I want to pull back on spending? Because I don't know what's going to happen. Similar to what I just argued earlier about SMBs here in the United States on hiring. Dang, I don't want to, I don't know about the hiring, because I can't predict what's going to happen in the future. But then I see this consumer demand, and then, that's always a lagging indicator. So with Canada, I probably think that's the case. And if we get a trade agreement signed next year, because recall, like I just said, it was always expiring in 2025. It needed to be renegotiated on an ongoing basis, and it's going to sunset again, and we'll have to renegotiate it again. But if we sign something next year, watch Canada business environment, kind of look upbeat, people borrow again, invest again, etc. Like once that news cycle carries over, Canada's probably back, back in business. Oh, and we need to close off the because I actually want to see what people said. So the consumer's dead. Dang, we ended at 50-50, 101 votes. All right, 50-50, consumer is dead. Well, half of you are wrong. I won't say which half. I get it. Half of you are wrong, and I keep it vague, so I don't put a line in the sand. Obviously, you know where I stand. Okay, let's talk about Alphabet. Let's talk about Alphabet. So, Google. The reason why Google is up, I think, has entirely to do with the narratives. Well, there's a few. So there was the Department of Justice case against them and the breakup concerns. Those are gone. There's the AI killing their search business narrative that I think is now dismissed. The TPU narrative added maybe some fuel to that fire, but I am not as a big believer in the whole TPU narrative for outside of Google's own workloads. I'm more of a skeptic when it comes to that. For a variety of reasons, because I think the NVIDIA bulls are they're a bit right, but they're maybe a bit too shooken, almost like at a sign of insecurity. But I do believe the whole ASICs thing, which again, it's not been a secret. It's been a thing for a very long time. It's more of an internal efficiency and going to be more of a benefit to Google internally. And when we talk about Meta's actually been using and experimenting with TPUs for a little bit now, by the way, fun fact. So, and Zuckerberg doing what he's doing now or saying what he's saying now, or not him specifically, but Meta kind of looking more into TPUs, I think is just a testament to how much compute Zuckerberg wants, which is horrifying. He wants so much compute, that guy. He's insane. He's signing cloud agreements with everyone and essentially pushing most of the available compute that he can find and just gobbling it up. Everything that Meta can build. And then he signs agreements with Google. He signs agreements with, Oracle as well. Meta's signing agreements left and right to use compute on top of their own build out, which is crazy. And Google, something I reiterated, the war, and I tweeted this out, hasn't really been fought yet. It's being fought now, but it hasn't been won yet. That's more accurate to say. And Google, when you actually do make the adjustments for gain on investments, is a lot more expensive than meets the eye. So the 31 EPS or 31 price to earnings is including the gain on investments, which I exclude all the time. I exclude that when I'm analyzing Amazon. With Amazon, I value it on a basis of free cash flow. And when you calculate free cash flow, you want to be very careful about, punishing for growth CapEx. So Amazon trades roughly at the adjustments for growth CapEx 20 times free cash flow. And another way to say it is 20 times true free cash flow. Meta, depending on how you argue it, can be in the similar ballpark range. The reason why you don't punish for growth CapEx is growth CapEx has an implied, return potential. And if you just looked at, raw free cash flow or just earnings per share, you might miss the forest for the trees, as you would have with Amazon throughout its entire trading life, by the way. You would have never invested in Amazon because it was always expensive on paper, and you would have completely just refused to read or acknowledge Jeff Bezos literally telling you how to value Amazon. But that would be a personal choice. It's up to you. So if you're using free cash flow, you're already implying the adjustments of gain on investment. And so with Amazon, you don't have to do that. With Microsoft, you also have to do an adjustment, fun fact, because in accounting, we have two methods for accounting for ownership in other businesses. We have the fair value accounting and equity method of accounting. So the fair value, the futures be green. I'll be pessimistic. They'll be red. Only because last week was green every day. But that's just a fun guess. So when we look at Microsoft, they're utilizing the equity basis of accounting when accounting for OpenAI. And then for Alphabet, they're including the fair value accounting for their ownership in SpaceX, Anthropic. So that is not anything to do with the operating of the business, and you should make an adjustment for that, just like you would if same with Amazon's. If you were for some reason using GAAP EPS to get an evaluation for Amazon, you need to do that. In the case of Microsoft, you have to make the opposite adjustment. You have to add back earnings. Fun fact, because Microsoft is having a negative effect from its ownership in OpenAI. Because with the equity basis of accounting, you attribute to yourself the losses in proportion to the ownership of said business. So when I'm Google, I just take the gain, fair value accounting. I just take the gain on the investment. And same with Berkshire. So Berkshire back in 2019, and there was an instance, I believe, in 2021 or 2023, where the PE ratio of Berkshire recorded itself at like 5 times. It was like 5 times earnings. This was because I think it was actually 2020. This was because Berkshire is using the fair value accounting to account for its ownership stake because it's buying common stock. You should obviously not include that in your valuation. Berkshire is maybe more appropriate to use like a book value and some multiple of book. And then you could also look at the operating earnings of the business alongside that. So, because they actually own operating businesses that are fully owned, yada, yada, yada. So all that to be said, if you don't do that, I got some stupid idiot, on X, saying like, oh yeah, why would you take that out? People do the dumbest things sometimes. Like, no, not taking it out is the dumbest thing ever, because then you would have been the dumb guy, saying like, oh yeah, you would have been directionally right on Berkshire, but buying it for like the complete wrong reasons. It'd be like the left bell curve purchase of Berkshire, because it is still a good company, but it wasn't trading at 5 times earnings. Because you'd be looking, oh, haha, PE of 5. I need to buy Berkshire. If you held it long enough, I think you did okay. But you did not appreciate in line of something trading at 5 times earnings. Okay. Because you're not accounting for fair value accounting. So for that being said, Alphabet currently trades at like somewhere close to 40 times earnings, and then forward it's like 30. So it's actually more expensive than Microsoft, and Microsoft is not dependent on advertisements, which I don't think it's been a very, very long time since I've seen Alphabet trade above Microsoft in multiple or valuation. And recall my previous conversation that I had with you guys about the war is not over for the consumer in LLMs. Doesn't seem like Meta going to announce a release big regarding AILM in the next 3 months. Oh, it does seem like Meta's going to announce. Yes, it does seem so. If you do this, so here's a great conversation I had with one of my members. I don't know what your tax bracket is, but that should also go into consideration about like what forward IRR you require of a new investment if you already held Google. I don't think buying Google now is appropriate. I think we're going to get another buying opportunity in Alphabet in the near medium term future. I think right now Alphabet is in kumbaya. In fact, our analyst Jesse played this like a fiddle, literally like a fiddle. And he is very happy to trim, not sell fully, trim his position to a more appropriate level to people who are becoming exuberant on Alphabet. And I think that's gonna age very beautifully. So in my personal holdings, I still have a ever growing, still, but still relatively small legacy position in Alphabet that at this point I'm not selling because of taxes, because about the conversation I was about to get into. I have a custodian account for a sibling, and in their account, I've trimmed it where it was 25% of the account to now it's so under 10% of the account. So it's about like 8% of the account now. And then just diversified the account more. But I think in the near term, we're going to actually see the war break out between what's going to happen with monetization on search alternatives. Because let me explain it this way. You did not have an alternative. I actually really liked a piece or a point written by one of the B of A analysts on this. His point, and he was pretty consistent. He was bullish Alphabet, while people were panicking. And fun fact, I blundered Alphabet. I had a synthetic long position I got rid of, like a dunce. That was like easily like 100K on the table on that synthetic. So, but one of the things he wrote was very fascinating, but it stuck through. Because it's true. When you really think about it, it's true. If you were cautious on Alphabet this year, you were way too early. Not necessarily wrong, but you were way too early. Because let's say I'm a whatever product. I sell hats. I sell whatever. And I put my queries on search-based queries. Like I advertise on search-based queries. The only option you have to this day is Alphabet ecosystem. That's the only one. You have DuckDuckGo, you have Bing, you have these other ones. Are you really going to use them? You're going to go with whatever gives you the highest ROI, but like the highest ROI is not them because they don't have a captive audience. Search has the most captive audience for search-based queries, right? For the longest time. There's no point in going to others. There's no alternative. So the ad dollars won't go there. Right now, there is a place where people can, or it does have a captive audience. We just talked about them, over 800 million weekly active users. So we're going to get to, Yahoo. Yeah, okay. Yahoo is another one too, yeah. But in realistic terms, in terms of having the most captive audience, Alphabet has the most captive audience in search. OpenAI has the most captive audience when it comes to LLMs. Again, over 800 million weekly active users. And again, that point of measuring in weekly is a sign of strength relative to measuring in monthly. So up until now, there's no place for you to go where the audience is, right? Because the types of ads, like YouTube really competes more against Instagram and Facebook. That kind of advertisement is more comparable to that. And on a search, like a search, like, oh, I'm traveling somewhere. Well, good places to travel. That's not really, that's Google and all these other search algorithms. But increasingly, that has changed, but they're not monetized. So when we start to see the first layer of monetization, remember ad dollars are not infinite. This is not an infinite market that is just like swelling of infinite spend. Like booking.com is not spending infinite ad dollars to acquire customers, right? They have a budget. The question now becomes, does Expedia, does Booking say, I'm using them as an example, we have like 800 million people using this thing over here, and they're using it a lot. And they're asking a lot of really deep personal questions. And it has a very deep storage of like, what you like, what do you, and you're giving it like in your query, right? You're giving it a lot of contextual information. I'll give an example, anecdotal example, right? So I tell it, I want a vacation in this area, and I'm going to give you a description of the hotel I'm looking for and the experience I want. All that context can be used to feed you a very accurate picture of like what it is you want. So in that case, in that sense, the LLM is like a really interesting way to plan something like that out. Now, how much, that's an unknown. How much, if any at all, because it could be that that's all bullshit and then they win the war. But the thing is, you have to be aware of the risk you're taking, because it could be they won the war. But I think you're making an assumption here. How much, if any at all, would booking divert in ads to this new format? So that's what we have to wait for. That's what we're going to see. Excitingly, I'm very excited, because what I do know and what you guys can clearly see is the market can get overly bullish and overly pessimistic, and it can happen very fast. And what I will say is that everything that I'm saying there is not a caution on Google as a company per se. Like, the company's not going to die from that. Google will outlive search for sure. Anyone who says Google will die without search, no. Google will far outlive search. Google has a ton of assets that are wonderful and will carry it forward, and will one day be larger than, I think, the totality of search. So there's no doubt about that. In terms of profitability, there's no doubt about that. Search is a wonderful business, and even then, search will be a probably more likely melting ice cube. But we'll see what happens, because it's still like a wait and see. And if you're buying it today, I think you're definitely concluding that. You're saying that's over and done with. But you haven't actually seen a viable alternative yet, is what I'm getting at. That's my fleshed out thoughts. Amazon has far less friction, in my view. Just does. Amazon Web Services, people, I think do not fully appreciate it at times. It goes in like a cycle. I mean, we already did a live stream where I covered why people were pretty silly for saying the things they said. They just don't listen to Jassy. When Jassy tells you slow down here, re-excel here, and people go like, oh my gosh, it's re-accelerating. Who could have predicted this? Well, Jassy told you. And so it goes through like the cycles of optimism and pessimism. And I think we're going to re-enter a cycle of optimism for AWS as it is re-accelerating, as the management told you. Surprise, surprise. And then hopefully we enter that pessimism cycle for Microsoft. And then people forget that it's basically still their right to win in enterprise AI. And like I was trying to hammer home to you guys earlier, that the winner does not necessarily have to be, like leaps. So if you're not leaps and bounds better than the competition, like where it's detrimental to use an alternative, then it's really about distribution and whoever has the attention already. So in order to take away the attention, right, you have to be leaps and bounds better. And so Microsoft has that enterprise attention. So Copilot, and I know people scoff at it and dismiss it a lot. We'll see what happens in a year from now. But my prediction and sort of like the counter narrative is that Copilot, despite being dismissed and scoffed at, is going to be what I call good enough. And the deep integration Microsoft has with the enterprise, they're going to monetize it beautifully. And we're going to having a different conversation in a year from now about that. So I'm hoping you get that strong pessimism down with Microsoft, which would be nice. Okay, but to answer your question, I think Microsoft's getting interesting. I think Amazon has been kind of interesting. Obviously, for all these, the answer is like, I'd prefer lower prices. And to be the most frank, there are lots of really good opportunities outside of these guys. But all three of these, what you're identifying is the hyperscaler theme, which has been a theme for like 15 years, is like, yes, it's good. These are great companies. Yes, they are. They're winning. Yes, they're going to continue to win. Ding, ding, ding. Congratulations. So yes, buy them. But I'm like, okay, I think Alphabet ahead of its skis. Amazon's fine. Microsoft fine as well. Could get better. Because remember, Microsoft is slightly cheaper than what it appears to be because of the accounting that you have to adjust for. Okay. Who owns YouTube? Alphabet. Yep. Of course. What is fake consumer? Do they buy Hublots? Consumers are using BNPL at alarming rates. I think Fabio misunderstands us. I know Andrew's trying to bait us into this conversation. So, yeah, Microsoft barely gives you any opportunities. Threat to our country. Oh, what's this? Would that be a problem long term for BNPLs as their delinquency rates might increase drastically, or if they're? So is Visa. So it's a. All right. So buy now, pay later. I'll explain it this way, because this was my aha moment, because I do understand where the friction comes from, because especially if you're a member of the super prime category of consumer. So for those of you who don't know, there's super prime, super prime, subprime, etc. I think I'm missing one. I'm blanking. I think I might be missing one. No. 08? No. 08 was so unique. Housing crash? No. I think things are not going to repeat the same way. Something crash, yes. Like in the future, will we live through a something crash? Probably. I think most corrections will be more like every other correction we saw throughout the cycles. But we might live long enough to see another crazy one. So an 08 style crash? No. When I see that, that's like a deep underappreciation of how unique that was. But I'm not calling out, by the way. I'm just saying it. I see this a lot, and there's actually a word for this. But so people who lived during the 08 crash and were investing during it, their studies indicate or show that managers who invested through that time period actually got some scarring from it in terms of pessimism. And there was, I think it was, I forget what fund it was that the fund manager he talked about this when talking about hiring. He wouldn't hire anyone who went through that. His reasoning for it was, and this kind of goes to what these studies indicate, the scarring they got from that made them permanently pessimistic. And the same thing happened to the generation that lived through the 20s, and then the subsequent crash in the 30s, the Great Depression. Because of that, they had this like scarring. There was some benefits to the scarring in the sense of like, people became more conservative with spend. So for like a household, right, that might be attractive because like you're not, blowing all your money, right? You're not taking on loads of debt. You're just being conservative. So like on a personal level, it's fine. On an investor level, it could be immensely detrimental because investing is about optimal risk, taking optimal risk, but the key word is taking on risk. So if you take on no risk, you're not going to get optimal returns over time. If you take on too much risk, obviously that's bad. So extremes are bad. But what's problematic in the industry is like if you do have that scarring and you constantly think about every recession and then you just remember 08, what you're doing there is like you're misunderstanding or misrepresenting what a recession typically is. I'll give an example, right? So what you went through recently is likely an example or an exhibit of a recent recession. You don't interpret it that way, especially if you lived during 08, because when you think of recession, you think 08. You don't think of what happened, what we went through in 2022 as anything of notable value. You're like, well, whatever, because you went through what they call, like, it's literally in the name. If I had to give you a hint, it's in the name, the Great Recession, right? The reason why they call it the Great Recession is to denote of notable, quantity or of notable measure, the Great. So, and then, the Great Depression. So to put notable measure to it, because we didn't see one like that for a long time. So will you see an 08? No, because then that would remove its of notable measure, right? It would suddenly be just like if every recession was like that, holy crap, that is of a a very particular experience, and one that if you live long enough, you might see something like that again, but probably not the same way. Like just the same way we didn't have the Great Depression twice for the same reasons. The Great Recession underlying causes were different than what caused the Great Depression. Thematically, it has all to do with leverage, but the underlying assets that were involved in the leverage were different. And that being said, like you could still have bubbles, but varying degrees of impacts of said bubbles. So you might always have some experienced investors had in the 08. You only need a flow camera. I think that a World War III scenario could be very impactful depending on how it escalates. Yes, depending on how it escalates. So I think it's like it could be worse. You're right. Like it could be worse. I won't say it can't be. What I'm implying though is that you won't have the same thing. You won't have 08, like housing crashed like you saw. That's not the cause. It's not like a blow up that you see. But a World War III where we just annihilate the entire population. Sure, that's worse. Yeah, of course. Exactly. So we're already on the same page. Copilot, that's my thesis to you. For Copilot adoption, it just has to be good enough, and people don't get that. I think Copilot is already good enough. It's being in M65 ready, and Private means enterprise would be more likely to use it if they're already in the ecosystem. And I know anecdotally, a lot of big four firms, they're saying, you can only use Copilot. A lot of banking institutions, you can only use Copilot. That's what's being integrated. So Copilot will improve. And what even Satya is telling you is that you're seeing this with like the LLMs. There's like this leapfrogging where, you make the advancements, you put all the investment, and then your competitor can just like leapfrog right up to you and be like, we're good enough. we're not as good as you, but we're like right under you. Thank you for, the push, so to speak. So, and this is more back to like, I know a lot of you might agree with this, and I'm like, yes, LLMs will be a commodity. LLMs, there's not going to be anything real special about having an LLM. The what's going to be special is the infrastructure to support it, which is very few companies that will have that, and who has the in the case of consumer, who has the habit built in. So OpenAI has that advantage. They have the habit built in. People are using it in droves and they're stuck on it, and that's like a moat to keep you from embedding it. But that doesn't mean that you can have some rinky-dink Chinese firm build an LLM that's comparable. Of course you will. Of course. That's not the question that we're asking. So like I can't tell you the difference. If I were to put them out, like we did the Coca-Cola Pepsi test, close my eyes, you type in a query into Kimi K2 on Perplexity and Gemini 3, I don't think I can tell you the difference. Really, I don't. Because if you do it on Perplexity, which is like now a format neutral platform, right, where the formatting is the same regardless, I couldn't tell you. And I'm being honest. Some people can say they can, but yeah. Yeah, brand is the weakest moat. That's why I was careful in saying habits is a very underappreciated moat, because like the brand per se, it's not really the brand, because like branding moat is what we would argue for freaking consumer packaged goods. Look how those are doing. Private label is actually hurting them. Go figure. That was a narrative that was dismissed for a very long time, by the way. Because I don't know, shout out to all of you guys who've been investing, at least over a decade. I think if you guys were participating in those discussions around consumer packaged goods, you might recall that narrative. And the investors in consumer packaged goods were like, what are you talking about? White label? That's been a threat for a long time. They're not disrupting anything. And so they are actually having an impact on growth. Oh yeah, that's without a doubt. I mean, they're literally saying that. Now that's actually the come to light. That's a popular point to say, like, why CPG has been weak. It's because especially with Zoomers and millennials, more so, they, more than like the older generations, it's like they're like, oh, I go to Costco, Kirkland, it's just as good. I'll buy the Kirkland toilet paper. I don't really care to buy the Huggies or whatever the heck. I mean, I'm speaking for myself. That's what I do. It's like Kirkland toilet paper. Why? Because it's just as good. You're like, oh, what milk do I buy? Well, I buy a Fairlife protein milk. TMI. Hey, you know what? This channel is no longer about investing. It's about Costco shopping hauls. No, all seriousness, like Kirkland milk, just as good. And then I'll get the specialized milk or whatever. But yeah, like I have like zero brand loyalty in CPG. That's a boomer thing. That's like a Gen X boomer thing. That's not really, it's less and less much pertinent to like millennials and Zoomers. But yeah, I agree with generally that. And the moat really is in what is my habit, right? That is very difficult to measure. What am I habitually thinking about? And that's hard to break. How do you break it? It's like the value prop has to be that much better to make me go, oh yeah, I'm gonna go do this instead. And then maybe I get addicted to your product and then I stay on there. Who changed their name to tell us about Dave? He's like, tell us about Dave. We can talk about Dave if you have a question. Bio, did you cover spike in inflation last 2 months already? Does it affect anything? The Fed? No, the next year. Dovish chair. I'm just joining. No, no effect. I think it's a foregone conclusion on that at this point. And I think they've already swapped to more caring about, and again, this is like kind of their recent commentary. It seems like they're caring more about unemployment. Yeah, and you're right. They've even said before, like, seeing through the tariff inflation, because that's not like real inflation. The inflation that they're, in the spirit of what they're talking about, it's not the same. Oh, the Polymarket IPO. They're IPOing. I had no idea. Well, I know International Continental Exchange owns a piece of that. All right. Oh, I accidentally skipped over a question. Your quick take on live person, please, if you have the time. Thanks. Okay. Let me take a look at these guys. I almost know nothing about them, but I'll look at them. So for me, already off the bat, I consider this an avoid, and I'll explain why. So this is a, okay. Let's kind of go over this. I'll share. By the way, I don't take sponsors on this channel unless I actually utilize the product. So when I say I like a product, and I use it, I will take the sponsorship from them. I said no to any and all. I mean, I'm not a big channel, but I have a policy. I don't accept the sponsorship unless I use the product and I'm like, well, this product is great. So as a reminder, the only real sponsor is the current sponsor I'm going to show you and myself. So link in the description for Capital Mindset Club if you want to be part of that. And also the finchat.io. So that being said, we're going to take a look using this. I'll share my screen in a second. I'm just going to prepare this because we're going to use the visuals here to kind of guide us through this. So this is live person. Let's ignore the stock price for a moment because let's not care about that. Let's first look at this, which stood out to me. This is actually where I first went. And so the story here tells me, without getting into further details beyond this, which we will get into, this is a story of a business that had a moment through clearly what looked like a blow up during COVID. And then a subsequent decline. So when I see a decline like this, coupled with the following, which the market is telling me something. If I take a look at the long-term debt, and let's go ahead and, so Exhibit A, right? This is where the market is telling you the debt is now basically more valuable than the equity. If you look at the enterprise value, it's substantially larger than the market cap. So the debt is a massive, massive overhang clearly for this company. And there's very few ways I've seen in the past of case studies of companies that are able to just like grind their way out of debt. There's exceptions, but typically it's very dangerous. The only way to get your way out of debt is growing your way out of debt. So growing the business, growing the profits, etc. And something else that stood out to me right off the cuff is they're dealing with, I remove the percent change to remove the noise. They're dealing with right now negative operating cash flows, negative net income, etc. So this business looks like it's bleeding money. So what you need now is like some sort of miracle turnaround. I haven't looked enough to see if there's something there that you're asking about, because like you notice something that no one else is noticing. But what I see here, unfortunately, is a debt-laden business with a declining revenue base. And that just screams to me value trap. I know of a lot of companies right now that don't look as complicated. So like if we take Adobe, for example, as I'm using them as a debatably value trap, right? Because people say like, oh, this is potential value trap. Well, there's reason why like it's not really the same thing. So Adobe conversely has up and to the right revenue growth, right? And it's the same across the board, operating profit up and to the right, yada, yada, yada. And then you actually come over here to the balance sheet and you can see on a relative basis, like the debt is very manageable if you look at, and especially if you just compare it to cash, like they run a pretty clean balance sheet here. So you don't have a ton of leverage. You don't have a declining business. You don't have declining margins. Really, it's not like a dangerous value trap where you might get clapped. You might underperform the market, sure, but I don't foresee like an obvious uh-oh moment. I think what you had as an uh-oh moment before is paying like 50 times earnings for the stock. Now, I really don't think so. Yeah. Oh no, Adobe $5. He will increase his position on it. All right, who's taking up on his bet? Someone. It's a Chipotle Bowl. Just have them take on more debt. Works for the government. Yeah. So, so I'll give you my constructed thoughts on government debt. And you might be new to the channel, but I totally get. I don't want to say that U.S. can borrow infinitely. I'm not one of those. Not an MMTer. I am more of like government debt isn't like the same thing as private debt for the reasons of its utility. And in fact, you could have a very serious problem if there isn't enough government debt issuance, just because of the Eurodollar system. So because I won't nerd out because we're on like 3 hours, and I hope you guys appreciate that we went on for 3 hours. I was only planning on doing like an hour and something, but because I'm a little bit autistic, once I get going, I can't stop. And you guys keep asking me questions, I won't stop. I won't even eat. It's pretty bad. But so government debt is much more of a tool than it is. Oh no, I did this before I was unemployed / retired, JJ. What do you mean? It was bad. It was so bad. But anyways, government debt, specifically US government debt, not every government, it's used as collateral. And so if you don't have enough government debt, you actually can freeze the plumbing of the financial system. So it's kind of like this weird dynamic where the government actually has a responsibility to issue debt to fuel the system itself, because the debt in and of itself is used as a tool, as collateral as an intermediate between various institutions across the globe. So if there were, for example, if you were to probably even cancel half the debt, right? Like you paid it off, you could probably start a financial crisis globally. Yeah, you could very likely start a financial crisis just by doing that, which is like crazy to think about. It's like, what if the US does austerity in that sense and like pays down half the debt and doesn't issue more debt, you would cause a financial. Yeah, you could freeze the liquidity of the financial system, which is like crazy to think about, but a lot of people don't think about that. So that's kind of like my stance on it. It's like not. I don't think it's infinite. I also appreciate that it's way more complicated, and it's like, they also need to actually keep growing the debt for reasons outside of the fact that, oh, we need to spend more money. It's like, no. It's also because like this weird use case that the treasuries specifically have within the global financial system. So I also was when I first learned that, it was also like, what the fuck? Like, what is this? What does that mean? So wait, tell you what, I'm confused. No. So tell us also why, as long as the dollar is the dominant currency. Okay. Oh, you want me to get into it? So I'll put it simple, because again, we just passed 3 hours. So because it's the dominant currency, because it's so utilized, and the utilization is actually, this is an interesting fact. It's been going up, not even down. It's actually been getting stronger. All this talk about replacing the dollar, blah, 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 bullshit. It's been going up, not down. So long story short, because the dollar is the global reserve currency, it's also the largest settlement currency, yada, yada, which makes a lot of sense given that. It's the actual treasury itself. It's used as a collateral asset for other kinds of transactions. So if one country entity is engaging in commerce with another country entity, the banking relationships, the banking plumbing of that transaction, even among US enemies, by the way, it is in dollars. And so that collateral asset just so happens to be in this relationship, well, dollars, treasuries, which is interest bearing dollars, right? Effectively. Now that's not to be said about bonds. Bonds, longer term dated debt, it's like a totally different thing. All right, sorry, we got some comments on turnarounds. Okay, so they're in the middle of a turn. So yeah, it's basically, yeah, he's saying just Google if you want to know more. For everyone listening, just Google Triffin's dilemma, which is the word for it. So they're in the middle of a turnaround, cost cutting, debt restructuring, new product is increasing demand. They project positive cash flow next year. Appreciate you talking about it. Take a look at it. Okay, so you see, like those are things I can't know just by looking at it immediately. But yeah, if you know that there is a viable turnaround strategy here, I've seen companies turn around from the brink for sure. It's not impossible. It is very difficult. They have to grow their way out of it. So if you know they're going to grow, then yeah, it could be a buy. But if and I'm clearly saying or seeing that your thesis is not that. So if your thesis is they're going to return to growth, yes, it's very interesting. It will be very cheap. It'll be very scary for someone who doesn't understand that thesis, and they might want to wait for the risks to abide, and they'll accept a lower return than you. But if you're very confident that they're going to execute on that, yeah, that's viable. If they're going to grow their way out of the debt, if they don't grow their way out of that debt, that's very dangerous. We never see it. So. We don't do price targets. We're not a sell side analyst. Yeah, we don't do price targets. So we have estimates of what we think is like good attractive prices to buy at, but we don't have price targets. We don't think in that way. We think of everything in terms of relative value. So if Dave becomes relatively more expensive to other opportunities, that's a consideration for a sell, but we don't do the reverse. Okay, so if there's any last minute questions, I'm gonna head out. Oh, okay. Again, Fabio. Again, if the consumer is not dead, then why aren't you long SPG? Well, because SPG is an indirect play on that. Okay, so since you have not mentioned, but you are so right that when I remember you when you went long SPG, and I know you've done well. And again, being real estate, they're an indirect play on that. I want to play directly on that, which I think one of the ways to do that is consumer financing. Okay, CNBC has a few people on saying something was going to happen, like a bubble of some type, going to happen that I know many tech people saying cutting back to lower outlook to lay off people. Well, the layoffs in tech, I think you're referring to, that's a lot to do with the overhiring they did. So if you have any friends in tech, they could test this. There was overhiring in tech, and subsequently a correction in that overhiring looks like a mass layoff. It's like, no, it's a correction. Yeah, and there is efficiency gains being had from likes of technology, right? Where we need less people to do the same amount of work. So all that to be said, that's not really like the end of the world. If anything, that actually adds fertile ground for the startup community, which before was struggling to find people in the hiring boom when companies were overhiring. Don't be naughty. Setting price targets is astrology for men. Yeah, in some regards, yes. I'll say it the other way to the person who asked about the price targets. Comment on that is like, there you go. We see startups are still struggling to find people. Okay. Yeah. Okay. I believe that. Good to know and hear that in the context of this conversation. But yeah, that's just the gist of it. The price target on Dave being fun here is like, so if it's trading at roughly to our estimate of like 10 times what we think of as earnings for next year. Based off of what we think they can grow at, I would not be surprised to see a 3 handle on the price. So that's kind of what I go about. All right, guys. I have a question for everyone. I have more time on my hands, and I want to get back into making videos. I enjoyed that, but I'm trying to figure out what the best format is. I love doing these live streams, right? Because I do videos unscripted. I never do a script for a video. I know you know what the best diss is like? Yeah, we can tell. Yeah, cool. And I never want to do scripted videos. I actually don't. I do one go on videos as well. I don't like to do that unless the only time I do like a pause is like if I need to bring something up to illustrate what I'm talking about. But on the videos question, I'm trying to figure out what the best format is for, you know, a guide on what videos to make. I used to do like okay, recommendations or like what people wanted me to talk about, because the algorithm thing, the thing YouTube has me like when I say what videos do people interested, I get so bored at talking about what everyone wants to talk about. And there was, because like you do like a video on, I don't know, whatever the fucking flavor of the month is, like quantum computing, because I find also the quality of the audience, you know, gets a little bit distilled. I'm purposefully not very goldfish friendly. I get that. That's purposeful. So if you can sit through talking or discussions, you know, good on you. That's actually the investor base we want in the club. If anything, we want people who have, you know, a bit higher attention spans and can kind of sit there and research things. And then when, you know, this collaborative and research oriented like that, that's what we want. So then always from the get-go, and that's, I think, how I've you know, gotten the audience that I have. So trying to still preserve that. But yeah, I'm thinking about different ways to just take recommendations, and then I kind of go through it like the old school capital mindset videos, where I just, you guys ask me for a stock, I go through with it. Unfortunately, how it is like, you know, 70% of the time I'm like, yeah, it's not that good of an opportunity. Maybe not what everyone wants to hear, but yeah. And then the occasional 30% of the time, oh yeah, this looks really interesting. Sometimes I do something about it, sometimes I don't. So yeah, okay. So I see it. Yeah, I know people do like the unscripted things. Oh, I mean, I would love to talk about all these different stocks, right? Talk about ARE, like all these are great ideas. ARE just cut the dividend. Like these are stocks that no one talks about. When is the next ICOM? So I want to see if Andrew and Jesse are available. For a reference, this is a public live stream. So part of the club, I do weekly calls, and we also do something called ICOM, stands for Investment Committee, where myself and the analysts, we do like sort of like a conference or a discussion about pitches, etc., and updates on prior pitches. And so for context, I am the only full timer now. And then end of year, you know, everyone has a real job. And so you know, the timing on that can be problematic for the other analysts, trying to get them all in the same time. So I don't try to be like too pushy, because like, you know, we are well, I'm not pushy at all, but we are at the end of the day, and this is like part of the sales prop, Andrew and Jesse are full-time professionals. So the timing of it can be, you know, kind of a wonky, especially like at this time of year, where, you know, end of year gets a little hectic. But ICOM, I think we've been still doing. Well, actually, I don't think we had one in November, but I've been still doing the weekly calls. So yeah, to quote Pennywise, yes, Pennywise, am I not good enough for you? Am I not real enough for you? That's okay. I still love you. But no, I'm gonna try to get them going. So I'll ask them if we can do one at least for this month, because there's a lot to update on. I think the last one we had was in October, but you still get into weekly calls. So in fact, I'm gonna do the weekly call today. So I'm gonna go eat because I'm insane, and we have a 3-hour live stream today, and then I'm going to go do watch it be a 2-hour weekly call, because a lot of things I also have to update you guys on as far as like portfolio and stuff. Pennywise Solutions, more guests. Yeah, more guests. No, so basically the way it kind of thinks is like we have the fund, right? But the fund and CM, it's like same but different, right? In the sense that a lot of the investor base of the fund is our CM members, and I'd say it's about 50-50, but that's not the point. So if CM grows more, I could bring them on more people, more assets, more resources, etc. That's kind of the idea behind it. It's like more CM demand, more size of community, more analysts who then provide regular ideas. But it's a crowdsourced community too. So, but yeah, people who want to be on camera though, that's not everyone. So a lot of people who would talk on text and stuff, but not a lot of people please have Cameron as a guest. Yeah, do it more friendly Euro times. Oh, the live streams, I'll try. What was going at GOF? Is that a ticker? I'm not familiar, and I know a lot of tickers. I'm not familiar with this one. Oh, yeah, because it's a fund, Guggenheim. Okay, so I said I was going to do these. I have more time now. I have a income portfolio that I only update it right now in CM, but that one I actually might start doing content on as well. And what I'm debating on doing is doing very infrequent portfolio updates for the public. But the income fund in particular is interesting because I think a lot of people, and the reason why I'm thinking about it doing this way, a lot of people damage themselves in doing too much high yield chasing. And as Kemmer has waved the white flag and led a lot of people, I think, off the cliff, I think there's lots of evidence to say there's a lot of appetite and demand for a strategy, because there's old folks on this platform searching, older folks, not old folks, older folks, where like, I'm not wanting to take on too much risk, but they don't know that they're taking all the risk because they think income is low risk, and they're not properly formulating a portfolio. And no matter what you tell them, index funds and chill, they won't do it. And so like, okay, work with them. What will they do? Because there's nothing worse than stubbornly pushing someone to something they're not going to do, and then you're setting them up for failure. You know what I mean? So it's best to position in a way that's like, okay, this is how I think will work, and I think this will be helpful. And I know that your brain is not wired for index funds, because I'm not. I agree, I'm not. So what is the kind of best path for you if you're insistently you're not wired for that type of investing? Because I'll be frank with you, you'll be fine if you index and chill, or you should be fine. But if you really you find joy, like true joy in doing this yourself, then I'm not gonna dissuade you, because your brain's not meant for just chilling. There might be something wrong with us. So I'm speaking to the person listening, and if this resonates with you, it's like, don't worry, I'm with you too. There's something wrong with the both of us. So, okay. Yes, is the fund GOF. Wonder why it's selling off. The market up so strong. So already when I see strategic opportunities fund, I'm thinking of it. They invest in unique credit opportunities. There's a lot of these funds out here. So I'm going to go read. Okay. So it's a C closed-ended balance mutual fund, launched, managed by Guggenheim, blah, blah, blah. So as an external manager, already these are kind of because their incentive is not the best. So invest directly through derivatives such as covered call. Oh, right here. So the description tells me a lot more. So it's a covered call, put options to invest in stocks and companies, blah, 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 blah. All right. So they're trying to generate income from derivative instruments. So right here, there's already going to be a lot of slippage. So what they're exposed to, depending on, unfortunately, if they're kind of chasing yield, chasing, getting that implied volatility return paid for in premium, then you get into this situation where you might be taking on a bit more risk than you might otherwise anticipated. So for income funds, if you're kind of going up the risk curve, I think I'd stop it at anything like in unrated credit. So things like Main Street Capital tends to be the top of the top in a BDC, and so that's going to yield you like 7% or so. But that's like the risk, the top of the risk curve, I think, because with these, you really don't know what risk you're getting yourself involved in. They're very complex and they're very tax inefficient on top of that. So it's not even like you're getting some sort of benefit as well. Now with BDCs, to be clear, the tax thing also throw out the window. But at least with BDCs, I can kind of tell you based off of how they operate, both them and Hercules are pretty good operators. And they're like really good houses in a questionable neighborhood where there's a lot of bad operators. And also entities that are, third party or managed by a third party tend to have like the wrong incentive structure in place. So GOF, already just reading this description, I'm not, I don't know what they specifically are selling derivatives on, but that could be going down a lot, and that's how they're getting such a high yield. So it reminds me a lot of, like all these products. Ulti is an extreme example, but you have all these other ones that are a bit crazy. So I don't particularly, I'm not a fan of any of these type of instruments. I look for more sustainable, durable cash flows or assets that provide, some sort of reliable income. Now, this asset, if you kind of zoom out, has not cut its dividend ever, but that doesn't tell me much of anything else. So I'm looking through. They actually have some interesting assets. So diversification looks like they have holdings in, I mean, this one's interesting. FTAI Aircraft Leasing Fund. I'm long FTAI, so that's kind of interesting that they're an investor in that. But I'm glad to know that they're paying me money, or they're giving me money, not me specifically. You know what I mean? All right. With that being said, guys, I wish you guys all the best. If you guys liked this very long live stream, please feel free to like, share, subscribe, comment down below. I'll leave you guys off with the question: how would you guys like me to return to YouTube? Would you prefer kind of offering me up like, oh, can you do a video on this? Can you do a video on that? And I just go off of those videos like the old days. Or I kind of just wing it, or a mix of both. I think I know what the answer is. I'm kind of leading you guys on with what probably the answer should be, but I'm just curious to hear what you guys think. I don't want to stop doing live streams. Love doing live streams, but yeah. And shameless plug, of course, the description also has, myself as a sponsor for this, and FinChat. Also, please read the disclosures down at the bottom. So I'm just letting you know that they're there. And so everything I said in this video or this live stream is just my opinion, does not reflect the opinions of the remaining partners at Fraxinus. It is not financial advice, and all investment carries risk. Please consult a financial advisor for all your investment needs. Investments carry risk, and my particular movements, needs, etc., may not match yours. Yada yada yada. All of that jazz. But please read the description below, or in the description below, for the full disclosures on all that. And I'll see you guys on the next one.